Welcome to the final class. This is going to be the final class that you will need to watch in your whole entire trading career to understand how to trade. I'm talking about in this 10-hour video, I am literally going to teach you from 0 to 100%. From the point that you are literally going to be able to execute a trade with me inside of this video live. Whatever I do on my phone, you pause the video, you do it on your phone. Whatever I do on my charts, you pause the video, you do it on your chart. I'm going to take you through the most step-by-step process that I have personally ever created or ever even seen online on a complete tutorial on how to teach you trading from 0 to 100%. This is everything in one spot. I swear to God, I wish I had this video when I started my trading journey back in 2019, 2018, when I was learning how to trade online. Nobody created tutorials like this. There was a bunch of different videos throughout the whole entire internet, and I kind of had to piece them all together. And by the time that I pieced them all together, I simply had an information overload and I didn't know what I actually needed and what I didn't actually need. In this video, I'm going to teach you everything that you need, and I'm going to briefly explain to you what you don't need so you don't have to simply waste time on it. Because the truth of the matter is that right now in trading, everybody is having a massive opportunity to make money online. The more time that you waste having the lack of knowledge and not having the proper education to go and trade, the more time you are missing on these profits. So I'm going to make everything on this one video. So all you have to do is just watch it from 0 to the end. You're going to know exactly how to be able to go out there and execute trades live in the market. Now, I have really been thinking about doing this video for quite some time. I just haven't had the time to actually get it done. But when I actually now decided to get this video done, I wanted to this be more than just an information overload video. Like, I wanted you to practice this in real time. You're actually able to go out there and execute live based off of this video. Something that you actually get value from and you're actually able to go out to the market and properly do it for yourself. Now, you're probably asking, who is this guy that's going to be talking to me for the next 10 hours? And is he even a reliable source? I've been trading the currency market for the last 7 years, and it took me about 3 years to become a profitable trader. I was 2.5 years trying to figure out how to make money online when it comes to trading. And after 2 years of watching endless amounts of videos and failing, I finally figured it out. But it really wasn't always about trading. I first wanted to make money online, but before making money online, I was working at Dunkin' Donuts. And before working at Dunkin' Donuts, I worked at Crocs, Aeropostale, Santa's Enchanted Forest, and I even tried to get a job at a valet parking, but I never got hired. I was just a regular high school student that got out of high school and did not want to go work the regular 9 to 5. I wanted to get out of high school and become a successful person. I wanted to become a millionaire. I remember as the semester was finishing, my professor came up to me and he woke me up from a nap and he was like, "Hey, just letting you know right now, you can not come back tomorrow or not even finish this semester. Even if you were to ace every single one of the next test, you're still going to fail the class." And I said, "You know what? Thanks, man. You just saved me the next 2 months of my life," because I was going to keep coming in here and falling asleep. Fast forward for the next 2 months, I kept going to campus because my parents were tracking my location and I had to go to school because they would, kick me out of the house, ground me if I wasn't going to school. And I was going to school to just figure out how to make money online. I was figuring out a way on how to do drop shipping, which I tried to buy multiple different products, but my credit card limit wasn't enough. So I couldn't have enough inventory. Tried that for a little bit, dabbled with it, never had success. And then I tried Airbnb arbitrage. So on my free time, as soon as I finished work and got out of the school, just sitting in the library, trying to figure out how to find the good properties for Airbnb arbitrage, I realized that when I did find a good property, I didn't have the proper credit. I didn't have the bank statements to sign a lease. So then I can sublease it, put on Airbnb, so on and so forth. And I pretty much wasted about 6 months of my life trying to make money online when it came across, these different businesses. And then one day, one of my friends invites me to this event where they're teaching trading. And I'm like, "Oh, dude, I've heard of this stuff before. Supposedly it's a scam. It's not real." I said, "You know what? What's the worst that can happen? I lose $100. Really all I have at the time to risk on this." I go to the event, I get sold on the whole entire MLM product, multi-level marketing. And what that really did is that it opened the doors to what trading is and the possibility that it actually has. I was there for probably 30 days. I realized that these multi-level marketing companies don't teach you how to trade. They just teach you what it is. But that opened the gates for me to actually go out there and try and figure it out. So I tried to go on with stocks, and I realized in order for me to actually create an account in a stock market or with a stockbrokers for you to actually go trade, it was a minimum of 25,000. That was back in 2018, 2019 when I was starting to trade. I didn't have 20,000, 25,000 $2,000 to open up a trading account. So then I heard that there's this Forex market, it's foreign exchange, where the entry barrier is $100, $50, and you have leverage up to 1 to 1,000. And then there, that means you have a lot more buying power in your money. The markets are open 24/5 compared to the stock market. They're open 9 to 5, 5 days a week. I said, you know what? This is a lot more attractive. Let me actually go headfirst into this. And little did I know that I was going to be walking into one of the longest, darkest, and loneliest journeys that I have ever been. And that journey began by myself in the library at Miami-Dade College campus. I was a whole entire year going to Miami-Dade College campus. Instead of me learning English or learning mathematics or whatever they were teaching me in criminal justice, I was learning what the foreign exchange market was. Watching endless amounts of videos on YouTube, buying a bunch of different courses, trying to see if it all worked, where it all came down to one simple thing. And all of that, I'm going to be teaching it to you guys in this video completely for free. And it's all going to be in one spot. I had to piece so many different videos together that literally, that is probably what took the most amount of time. Getting all the information that was on the internet, hearing the same thing 7 different ways, realizing I'm watching the same thing from a different person saying it in a different way, and then having to minimize all that information for it to come down to one thing. And that is exactly what I'm going to be doing in this video today. And it almost feels like it went by extremely fast now that time has gone by. But after 6 months of me just trying to put all this information together, lost a couple $1,000s. Another 6 months went by, and then I was supposed to be graduating from college, getting my AA on pretty much year 2. And my parents realized that I was not going to college. And there I had to pretty much break them the news that I was doing this whole trading stuff. And I was probably about a year and a couple months in. And I was so deeply invested that I had no other choice but to continue to go. There was no way I was going to continue and figuring out a different way on how to make money online once I've already invested a whole entire year into this and things were starting to click, or at least I thought they were at the time. So I basically broke the news to my parents. I said, hey, I'm trying this whole trading stuff. I need you guys just to give me some time to figure it out. My parents did not believe in me. They weren't supportive of it, and I wouldn't either. I have old school Cuban parents that they barely know how to use WhatsApp. They don't speak English, and they honestly just all they understand is work on a regular job, and that's how you're going to become successful. It's not their fault. They were raised differently, but I knew that there was different ways on how to make money in this world, especially online. So after about a year and a half, my parents aren't supporting me. I'm just kind of living there at the house. I'm literally trading from my mom's closet. We have a closet downstairs, and I'm just trading out of that closet. And I'd say probably for the next 6 to 8 months, it was a battle in between myself and understanding the actual markets. So now I know exactly what trading is, how it works, but now I'm just trying to figure out these patterns and if there really is one behind it. And I'd say after 6 months, it got to the point where I was seeing the patterns. I would see things happen over and over again, but I just wasn't entering at the exact point. I was either entering too late, I was entering too early, and I was probably closing out my profits too short. My stop losses were too tight. I was just doing a lot of minor mistakes that all accumulatively made me a unprofitable trader. Right around the 2-year mark, my parents once again are pressuring me. What am I going to do with my life? And I just kept asking for time. I'm still working at Dunkin' Donuts, dabbling other jobs, but I'm trying to dedicate as much time as I possibly can to trading. Now, at this point, I seek some different types of more serious mentorships. I understand a little bit more. You need an actual strategy for you to actually become a profitable trader. And right around the 2.5-year mark, I went from losing consistently for 2.5 years to having my first ever break-even month. I'm like, well, I think I might be doing something right, because you know what? This month I didn't blow any accounts. I didn't lose any profit from accounts. Like, I think I'm onto something. The month after that, so 2 years and about 7 months, I had another break-even month, but a little bit slightly in profit, probably 1%. And then the month after that, I was in profit 10%. I went from being an extremely unprofitable trader to then a break-even trader to then having my first profitable month. All of that in the span of nearly 3 years. And in this video, I'm going to shorten what I learned in 3 years, all of the mistakes that I did, all the unnecessary information that I had in just a 1-class setting. This is going to save you guys so much time, so much headache that I wish I had this when I got started. After my first profitable month, everything literally just clicked. I started going from break-even months to a profitable months to then just this becoming the new normal. All I had to realistically do was look back at my actual winning month and be like, what did I do right there? If that's what worked, let me just double down on it when I see it again, and then again and again and again. And then you fast forward for another year. So I'm about 3.5 years into my journey. I am now a full-time trader. I think on my 3rd year, 3 years and 1 month. I left Dunkin' Donuts, left my job, and I'm now just a full-time profitable trader. Told my parents that it's actually working. They're seeing the money, they're believing it. And then right around my 4th year, I decided to just start posting on social media because that was the only way to pretty much meet people as a trader. Because if you're a trader, you're kind of in an office like this, you're just home 24/7. You're never going to really engage with anybody because you don't need to go out to a social setting for anything. Everything you could just do it from home. And all of my friends that I had in my journey as I was learning trading, all of my high school friends, I pretty much separated myself from them because they didn't believe in my journey. They didn't understand what it was. And they were causing me so much stress trying to convince them of what it is and that it's actually possible that it was distracting me from the journey. So at this point in my journey, I'm really by myself and I'm just trying to open up my doors to new people, just meet people, maybe meet some new girls, attract girls, because I'm realistically just making a decent amount of money by clicking a couple buttons and I have so much free time throughout the day. And like a hurricane or like a snowstorm or whatever you want to call it, it just blew up. I started posting, I bought my first supercar, which is an Audi R8. I started posting profits. I'm making a couple $1,000s every single day. And out of nowhere, this created this massive community of other people wanting to learn how to do the same thing. The questions that I was getting asked were pretty simple questions. And I decided to say, you know what, let me just start helping people. And I just started posting YouTube videos, and fast forward another 3-4 years, and we're here where I arguably think I have one of the biggest trading communities in the industry, and I have helped thousands of people all around the world and shortened their learning curve from years to months, and gotten people to make tens of mistakes a day to maybe one a week, and then them learning from that and using those losses that they avoid to optimize and actually be able to risk the correct amount of money on the right markets. So it all went from being a unprofitable trader by himself to then developing a skill set without even knowing it, posting it accidentally on social media, it blowing up, now to the point where I just changed traders' lives all around the world. And now this video is for you. And the only reason why I gave you this whole entire backstory is so you understand at the point where I am right now in my journey. I have so much free time that all I genuinely have passion about right now is just helping other people. I am literally dedicating more than 10 hours to make this video for you, because this video is gonna probably be 10 hours and I'm done with it. But for me to record it, for it to all get shortened down to the point where I probably put 20-25 hours into this video. I'm doing this for you. So all I ask for you is to literally only focus on this video. And if by the end of this video, you did not learn anything, you have absolutely no value, hit the unsubscribe button, block me, never look at me ever again, don't believe me. But I am putting so much time and so much effort into this video because I personally really do wish I saw one of these videos when I got started in my journey. So if you have any question, if you have any concern, just go back, pause the video, write down notes. If I were to show you the amounts of notes that I took when I was learning in my journey, I think I wrote down the same thing 15 different times because I was watching 15 of the same videos just in different ways from different people. And that confused me so much because everybody would say it in a different way. And what I can guarantee you is, in order for you to become a profitable trader like me, there is no other video that you need to watch online, including my own, because this video is literally going to teach you every single topic, every single subject that you need to know to understand the markets exactly that I do. Once this video is finished, the only thing that separates you and I is going to be experience. And that is what's going to lead you to become a profitable trader. So right now, if you're driving, if you're at work, you're on a lunch break and you started this video, make sure you pause it, put a bookmark on it, and come back to it when you're ready to sit down and actually focus. Do not half-ass this video. Do not put it on 2x. The point of trading is for you to take your time with it. This is a marathon, not a sprint. And you attempting to learn this information faster is actually going to slow you down, because you trying to speed things up and get all this information as fast as you can, it actually slows you down because you're not going to process it and understand it, and you're gonna have to come back and watching it again. So it's going to actually take you double the amount of time. No matter how fast you want to learn this, it takes time, it takes repetition, and you need to understand this is a brand new language. And a perfect analogy that I can put is, let's say you're going to go build a house, and the same day you buy the land, that same exact day you have the builders, you have the plumbers, you have the roofers, you have the carpenters, you have the landscapers, everything. You cannot have the roofers put on the roof if the builders haven't even built up the walls. You cannot have the gardeners put up the garden if they haven't finished the construction, you're going to mess up your garden. Everything is a step-by-step process and it takes time. And that is exactly what this video is intended to do. It's intended to go step by step in the correct order and for it to be taken my time for me to explain to you so you understand it at the correct time. Now, with that being said, let's officially begin this video. And if you are not 100% ready to write down notes, if you don't have your notepad out, if you're not in a calm setting, if you're not locked in, you don't have your headphones in, do not watch this video. Click the pause button and come back when you're ready. It's going to be a lot more effective that you watch this video when you are 100% prepared to actually watch this video. So you take notes effectively and you understand everything effectively. So with that being said, let's begin. So what is this trading stuff? What is this Forex? What is this stocks? What is this crypto, indices, commodities, futures? What is this charts? What is trading? Well, I'm sure we've all seen charts, right? This is what a chart is. A chart is when something goes up or something goes down. You've probably seen it either on an actual candlestick format like that, or you've seen it on a line chart like this. These are different ways on how the markets are seen. You can see it on a line chart, you can see it on a bunch of different ways, and don't worry, we're gonna get into all of those different ways in just a second. But what exactly is trading? Well, trading is when you're literally doing what it says. When you are trading, you're trading one thing for another. Now, some people think when it comes to the Forex exchange market, the foreign exchange market, that you're actually trading one currency for the other. Some people think that, oh, the euro and the dollar, you're actually buying the euro and you're exchanging it for the dollar, or you're selling the dollar and then buying the euro. At no point are you ever actually doing that. You're essentially just betting that something's going to be going up or something that's going to be going down. We're going to get into all of that in just a second. Now, before I actually get into the charts and I show you how to actually read the markets, I first need to teach you and educate you on the actual markets. What are these markets? What do they consist of? How do, like, when I actually buy a currency, am I actually owning it? Like, do I actually buy the euro? Does that mean that I own the euro? If I actually were to buy gold, does that mean that I actually own gold? If I were to trade the NASDAQ, do I actually own a piece of a company? So let me break down these actual markets and what they consist of, right? So right here, we're going to have all of the main markets that are going to run the trading industry or the trading niche. And these are in order. The first market is going to be the foreign exchange market, also known as the Forex market, where every single day it moves anywhere from 7.5 to 8 trillion dollars on a daily basis. This is not only the largest market in the world, but it is actually decentralized and it is open 24/5. Now, when I started trading in 2018, 2019, I remember reading this exact same sentence right here, and it was anywhere from 5 to 6.5 trillion dollars. The fact that in just 5-6 years, this has nearly almost added $3 trillion into trading volume is absolutely absurd to me. This just shows the amount of opportunity that is inside of the foreign exchange market. So the beauty of this market is that it is available 24/5. You can pretty much trade it whenever you want throughout the week. And that is the beauty of the foreign exchange market. It is the most volatile market, has the most opportunity in it, and it is available the most out of any single market. Next is going to be the stock market, which you've all heard of, the New York Stock Exchange. That's where people would trade on the trading floor. And this is where the global stock market trade. And it's anywhere from 200 billion to 300 billion on a daily amount. So you can realize the magnitude and the size of the foreign exchange market. It is nearly 15 times bigger, 20 times bigger on a daily basis, because you're trading every single currency in the world. Right here in the global stock market, you're pretty much just trading around the US, mainly around the NASDAQ and all of these other different USA companies. Next, we have the commodity market, which is going to consist of futures, oil, gold, wheat, and the daily volume from this can vary in a couple of $1 billion, but it's around 100 billion on a daily basis. Now, when you go trade the commodities markets, when you go, let's say you're going to go buy gold, for example, doesn't mean you actually are going to own a piece of gold. You're just betting, you're basically betting with the markets that gold is going to go up in price. That's pretty much it. When you go buy oil or you go sell oil, at no point are you actually owning any oil. It's all digital currency. It's all money on the screen. They're basically making an educated bet if this market is going to go up or it's going to go down. At no point do you ever own anything when trading any of these markets, except the cryptocurrency markets. The cryptocurrency market has an average volume of 100 to 200 billion in day trading volume, but it is extremely volatile and is mainly controlled by Bitcoin and Ethereum and a couple of other stable coins. Now, obviously, the problem with cryptocurrency is there's, no centralization around it. It's completely decentralized, very much how it is when it comes to the foreign exchange market. But these currencies are backed by countries. They've been backed by hundreds of years. The crypto market is still fairly new. It's been around for, let's call it 20 years at the max, 25 years. And it's something that is completely decentralized. And when you actually trade a cryptocurrency, let's say you're trading Bitcoin, you actually own it. If you trade Bitcoin and it goes up, you make money with it. If you trade Ethereum and it goes down, you lose money with it. Same, very similar how it works with the foreign exchange market. But when you're trading the foreign exchange market, at no given point, you actually own some of the actual currency. Let's say I'm trading Euro USD, at no point do I actually own Euro or do I own USD. So all of these, I'm going to go into great detail of how you can actually trade them, which ones you should be trading, which ones you shouldn't be trading, and how you can actually build a profitable strategy to actually trade on these markets. These are going to be the main markets that are going to be out in the markets and that you should have any interest in trading them. Any markets outside of these, they simply don't have enough trading volume. And if they don't have enough volume, which is big numbers like this, the odds of you becoming a profitable trader are much more difficult because lack of volatility means lack of opportunity. You want to make sure that you are in a market that has a fair amount of volatility, not too much because then you're prone to getting major losses, and all of that I'll explain later into the video as well. But you want to make sure that you have a decent amount of volatility so you can have good opportunity to actually make money when it comes to trading. But I personally have been trading the foreign exchange market for the last 7 years successfully, and lately I've been dabbling a little bit with commodities, and I just have been investing into crypto when it comes to long term. This is my form of an asset. I would much rather put multiple six figures into a digital currency where it can make me 20-30% annually compared to putting it into real estate where, let's say, it can make me those same returns, but I have to deal with less headache. I've never personally traded the stock market just because I am not interested in trading in a market that does not have anywhere near as much volume or availability as the foreign exchange market. I've traded the NASDAQ, I've traded the SPX 500 and all of these other stock markets, and you can also do that in the foreign exchange market. And all of that, we're going to be breaking that into this video, and we're going to be actually taking a trade together. You're going to be able to pause the video, look at the profits or losses on your actual end, and then you're going to be able to have a clear understanding of how to actually do this for yourself. And now, before we get right started into what is actually trading, I want to bust every single myth that is out there online. All of the myths that my parents thought that this was, that even including myself thought this was, or just the people that have an opinion on something that they're just simply not educated on. And there's nothing wrong with having an opinion, but it's always good to get educated on it. So I'm going to bust every single myth on what trading isn't. Trading isn't a Ponzi scheme. There is Ponzi schemes out there on people creating systems around trading. That is entirely true. But trading itself is not a Ponzi scheme. Like, people are just essentially betting that something is going to go up in value or that it's going to go down in value. If it goes up in value, people make money. If it goes down in value, people lose money. That is what trading is. So no, it's not a Ponzi scheme. Also, in order for you to actually become a trader, you don't need to be a mathematician. You don't need to go to college. You don't need to get a degree. You don't need to be a genius. To be fair, I graduated high school with nearly a 1.7 GPA, I think it was, or a 2.0 GPA. I can't even remember what it was. I barely passed high school. I failed at college. I was not the smartest kid in class. But what I did do was show up every single day to try and figure this out. I had a driving mindset that was going to lead me to success, but I did not know what was the root square of 75 when a car is driving at 50 miles an hour and x equals 5. I have no idea to this day what that is, and I don't need to, and I've had 2 Bugattis, so I think I've done very well. Trading is not something that you need to have habits for. You don't need to wake up every single day and meditate. You don't need to wake up and light up a candle, read a book, set a certain light. All of that Instagram, TikTok stuff, that is not real. You do not need any of these morning routines in order for you to become a successful trader and understand how to read the markets. I can be looking at the markets in front of my computer. I can be looking at it on my phone, about to board onto a flight. I can be looking at it while I'm driving, while I'm at the beach, while I'm doing anything. All I need is a screen and decent amount of internet, and I'm able to go ahead and look at the markets. You don't need to set up a whole entire ambiance around you to actually read and understand the markets. If you know how to read it, you know how to read it. And trading is also something that a lot of people think like, oh, we're going to wait for price to come all the way to the bottom so we buy. We're going to sell all the way at the top. We do not try and predict tops or bottoms. Actually, on the complete contrary, I want the market to be moving up very aggressively, and I want to buy with that market. The trend is your friend. I've had that quote on my desk, I think, for 7 years. The trend is your friend. I am not here to create a trend. I'm not here to break a trend. I'm here to trade with the trend. What do you think is easier, to swim against the current or with it? And here in trading, you are here to swim with the current. At no point are we ever trying to predict something when it hits all the way at the bottom and then we buy, or something when it hits all the way at the top and then we sell. We trade with the trends. And another one of the biggest misconceptions that people have is that they think that they need to be in front of the markets all day in order for them to actually read the market and become a profitable trader. Do you need to be in front of the markets for a long period of time for you to actually understand how the markets move? Yes. But once you get it, you don't need to be in front of the markets every single day. Another one of the biggest misconceptions that traders have, or people in general when they get started into trading, is that you need to be in front of the markets all day, every single day in order for you to be a trader and a profitable trader. That cannot be further from the truth. The less amount of time that you spend in front of the markets, the more amount of money that you're going to make. It's very counterintuitive because at the beginning, you actually need to spend a lot of time so you can learn and practice it. But once you understand the skill set, then you don't need to be in front of the markets all day, every single day. It's like when you're going to go learn a language. Let's say you're going to learn Chinese, for example. It's your first time learning Chinese. Are you going to have to spend more time than the regular person that wants to learn Chinese in the class? Yes, you're going to have to spend more time. But after you learning Chinese and being in the class for an extra hour every single day for the last 6 months, it gets to the point where you no longer have to be in class for you to understand Chinese and to perfect it. You could be listening to some music. You could be interacting with people on the street. That is where you practice it and you perfect it. And then you don't need to speak Chinese every single day in order for you to master it and perfect it. You just need to make it part of your normal routine and it just becomes second nature. Once you learn it, you're not going to unlearn it. It's the exact same thing with trading. Once you learn it, you don't need to be in front of the markets every single day to trade. You only trade when it's time to trade. And by far, probably the most important one, people think you need money to make money in trading. And I'm going to answer this. The answer is true. You do need money to make money, but you don't need a lot of money to get involved into trading and make a decent amount of money. You can get started with a couple $100, maybe a couple $1,000, and that is going to lead you to have returns equally to what you invest. It is all based off of risk to reward. If you risk $100, you're going to make a couple $100. If you risk a couple $1,000, you're going to make a couple $1,000. You're not going to turn a one single-handedly $100 bill or a couple $100 bills into a quintillion. That's not going to happen. Can you multiply it and scale it over time with proper risk management? Yes, but you don't need a large amount of money to get involved. And people have this conception as well as soon as they put the money into the market, it's automatically gone. No, that is the complete opposite. You actually predetermine how much you want to risk of the capital that you put into trading every single time. Let's say right now I go and deposit $100 into the broker that I'm going to be using. That doesn't mean that $100 is invested right away. That just means that the money is inside of a platform that then I can go and execute one of these positions on. Now, before I execute that position, I'm going to pre-calculate my risk on my $100. I only feel comfortable risking $10 on this trade. That's all I'm going to lose. And I'm going to be teaching you guys on how to do that throughout this whole entire video. But I want to make it extremely clear what trading is not. Okay, so now that you understand that there is different types of markets out there, you have the currency market, commodity stocks, you have the crypto, there's many different types of traders that execute on these type of markets. For example, we can have what is called a position trader, which these are also known as whales, which these traders happen to take anywhere from 1 to 2 positions a month. These are people that have large sums of monies and they're realistically not interested in being active every single day or every single week. So now moving on, now that you understand that there's many different markets out there, you have the foreign exchange, the stocks, the crypto, all of these different markets. There's different types of ways of trading these markets, and there's many different types of traders that execute these markets. Now, you can trade these markets as if you were to be a position trader, a swing trader, day trader, or a scalper. You can be any one of these traders and execute this style of trading on any one of those markets. For example, if you were to be a position trader, these are also considered whales because they are risking large sums of money either once or twice a month on certain positions that they take. They aim to have anywhere from 2 to 3 to 4% a month, realistically, with minimal effort, minimal activity, and just large sums of money. These large sums of money this is why they're called whales and position trading, but this is more for kind of institution style and people that aren't really active in front of the markets every single day. Can you make money as a position trader? Of course, but it does require large sums of money because you're looking to target bigger trades. So you're going to have very, very, very big take profits, very, very, very big stop losses. I've attempted this style of trading in the past. It's just very expensive because you have to risk large amounts of money because you get charged every single time you hold a position. And I'm going to get into all that stuff later into the video, but this is a future way of, I think everybody will eventually become a trader of as you progress throughout this whole entire chain. Next, we have a swing trader. So a swing trader is somebody that takes anywhere from 4 to 5 positions a month. And these positions that they take are not as big as the positions traders, but they are decently big trades. And these trades happen to have the best risk to reward out of any one of the traders. The swing traders are the ones that look on the higher time frame, but still incorporate the lower time frames to have entries and have great risk to rewards. I personally myself am a mix or a hybrid of a swing trader and a day trader. And this has led me to be able to have the sniper entries of a day trader and the take profits and the great risk to rewards and the big trades because of the swing trading approach. So a swing trader takes anywhere from 4 to 5 trades a month. The trades that they take are very sniper, very accurate, and they tend to be probably one of the more patient traders next to the position trading. Next to that, we have a day trader. So a day trader are somebody that are obviously most commonly known in the trade industry. We all know trading because of day trading. You trade every single day, but that doesn't mean that you're actually trading every single day, but you're more or less looking to be active either 2 to 3 times a week on a market. Really depends the types of opportunities that you get. Because typically if you were to enter a trade today, it should hit your take profit today. Maybe it can overlap into tomorrow. That's why you take anywhere from 2 to 3, maybe even 4 trades a week on the higher end. Day traders tend to have anywhere from a 40 to 50% win rate, but obviously they're taking a lot of positions and their risk to reward isn't as high. A swing trader's win rate tends to be anywhere from 60 to 65% because they're taking less trades, which the quality means that they're much better. And then a swing trader's win rate tends to be anywhere from 70 to 65%, but their risk to reward tends to be even greater than that. Last but not least, or like I would like to say, definitely least, is going to be a scalper. Scalp trading is probably what every single person thinks that they are when they come into trading, because people think that the more amount of positions that you are in, the more money that you will make, and that cannot be further from the truth. A scalper is somebody that tries to take 2 to 3 trades every single day, a trade every single day, and that actually overexposes yourself and puts you at more risk, because the more you get involved into the market, the more risk you are in. The more you're actually trading, the more odds you have of losing. The less you trade, the less likely you are to lose. So then you might ask me, wait, Alex, so then how do you actually make money if you're not involved? You make money by entering the right trade at the right spot and you let it ride. You make money while the market moves. You don't make money by getting involved into the market. Two very, very big they're 2 completely different things, and the quicker you understand that, the quicker you're going to make money in trading. You don't make money in trading by getting involved. You make money in trading by getting involved at the right time, at the right place, and let the market move. Let the market do its thing. Let it create the market structure, let it go up, let it go down, whatever you're doing with it, and that's where you make the money. Every single time you enter a position, you're adding more risk to your account, which in turn can end up to you losing. Yes, it could also mean that you can make money, but nowhere near as if you were to enter one solid position and you let it run. If this doesn't make sense right now, don't worry, it's all going to click throughout this video. Right now, I just want you to have a deep understanding of the different types of traders that there is out there. My personal favorite is going to be a day trader or a swing trader. and then the happy medium right in the middle. Everybody starts off as a scalp trader because they want to enter a bunch of positions thinking they're going to make more money, but then they end up developing and growing as a person and become a day trader. So these are the main types of traders that go and execute on either the foreign exchange market, the stock market, or the crypto market. Okay, so now that you understand that what type of markets you're going to be trading, the type of trader that you can be on this market, let's actually start breaking down the exact markets that you are going to be trading. We'll figure out what type of trader you are later in this journey and see which one makes the most sense for you. But the most important thing that you understand is what type of markets you're going to be trading. So we're going to be breaking down the foreign exchange markets. This is the most volatile markets, the markets with the most amount of opportunity and gives you the most possibility to make the most amount of money. So we're going to be breaking down a forex pair, a currency pair, a market that is consisted of currency, right? So as you can tell, all of these markets here to my right hand side, they're all different types of currency markets. The USD versus the CAD, the pound versus the Canadian, the Australian versus the Canadian. And don't worry, I'm going to teach you how to set up this whole trading view, all of this Chinese that you think this is a new language to you. Don't worry, I'm going to help you set all of this up. But we're going to first start off by breaking down what is a currency pair and how does this even work? Well, in order for you to trade the foreign exchange market, you have to trade one currency against the other. You're basically betting that one is going to get stronger than the other, or that one's going to get weaker than the other, which in hands is the same exact thing. If something gets stronger, that means the other gets weaker. It's very simple. So all we are doing when we are trading a currency market is we are betting that something is either going to go up or betting that something is going to go down. At no given point, if I'm trading the Euro USD, for example, which is this market that we have here, at no point am I ever actually owning any actual euro, or am I actually ever selling the dollar against the euro or buying the euro against the dollar. If I'm trading the Canadian dollar versus the pound, at no point do I actually own any physical Canadian dollars or do I have any British pound. At no given point. All I am doing is I am betting that one is going to get stronger than the other. So how does this betting work, you may ask? Well, it's very simple. This is a currency pair. It's made up of two different currencies. The first currency is going to be the base. So this is the base currency of the pair. Then we have the quote currency, which is the other currency pair. These two markets are constantly in a battle. Who is stronger than the other? If this market decides to continue to go to the upside and it starts creating market structure like this to the upside, that means that the euro is stronger than the dollar. If this market is then moving to the downside like this, then that means that the dollar is stronger than the euro. Now, how would I know that? How does that make sense? Well, it's very simple, because this base currency is what's going to drive the price up. If we are currently with a very strong euro market and the euro is very, very, very strong, that is going to mean that it's stronger than the dollar and it's going to push price to the upside. If the dollar is going to become strong, then that means that it's going to be stronger than the euro and it's going to push price to the downside. So this quote currency, the best way to understand it is if it's getting strong, you want the market to go down. If this base currency is getting strong, you want this market to then go up. Now, I wanted to be very clear. When you want this market to be strong, when you want the euro to go to the upside, you want to buy this market. You're going to buy Euro USD. Once again, you're not buying any euros. You're essentially just betting that the euro is going to get stronger than the dollar for a period of time, whether that be a couple of hours, a day, a week, a month, whatever the case is. But then if you want to sell Euro USD, at no given point are you actually selling the dollar. You're just betting that the dollar is going to get stronger than the euro. So are they both equally as important? Can they both have equally the same amount of moves? Absolutely. Just because a market is going up doesn't mean that that's going to be more probable or stronger than a market that is going down. Remember, this market going down doesn't mean that the dollar is getting weak. It actually means that it's going to be getting stronger against the euro. So whenever you are selling Euro USD or selling any market, you're basically betting that this market is indeed getting stronger than this one. It really comes down to the way it represents. In this battle, or in any battle, if somebody is winning, that means that they are standing up and fighting, and if somebody is losing, they fall down to the floor. Well, in this market, it's actually the complete opposite, because this fight never ends. This fight is a forever going market between the dollar and the euro. Markets going up, markets going down. And whenever the markets are going up, that means that the euro is winning the fight. Whenever the markets are going down, that means that the dollar is winning the fight. But at no point does the fight ever end. The fight is always going to go on as long as we have both of these currencies. So whenever the fight is going down, that means that the dollar is getting strong, the euro is getting weak. Whenever the fight decides to continue to go back up, that means that then the euro is going to be getting stronger against the euro. That's really what it comes down to. These are two fighters fighting up and down. And then whenever they're going in one direction, that means they're getting strong. Now, what are these numbers right here, right? What is this numbers that keep going up and down? Well, this is actually probably the most important thing that you need to understand what it is, but you're never going to actually use it because you don't really care what the actual exchange rate. So these numbers right here are the exchange rate of the actual currency pair. And as you can see it right here on the live market, that's why it's 1.17. So $1.17 is going to equal 1 euro. That is really all that this is right here. So this just lets you know where the market is in terms of price. And these numbers going up and down is what's going to lead you to determine whether, okay, I want to buy or I want to sell. But at no point are you ever actually going to be looking at these numbers. These numbers just reflect what the actual charts are going to be doing. When we go to the candlestick charts, these charts will just reflect on this price right here. This price is going to reflect on these charts. So this right here is what a currency pair is. It's a battle of both of these markets 24/5 for the rest of history. And whenever one is going up, that one's winning. And whenever this one's going down, this one is winning. There is endless amounts of currency pairs out there. I personally trade myself 15 to 20 different ones because there's just more opportunity on the more markets that you trade. And there is more volatile currency pairs, and then there is less volatile currency pairs. Obviously, currency pairs that are less commonly known, let's say like the Noggin or the Mexican peso, that don't tend to have as much volume compared to the US dollar, to the euro, or to the British pound. They're going to be a lot less volatile. Can you still trade them? Can there still be loads of opportunities? Of course. But the odds of you making big moves on those markets are very unlikely. Can you still do it? Yes. And I'm going to be educating you how to properly do that as we continue to go on throughout this video. I just first want to teach you exactly what a currency pair is and how it works, because this right here is what you will be trading 24/5. And you need to understand exactly what you are doing whenever you are trading these type of markets. And these right here are going to be known as the major currency pairs. You're going to have your euro versus the dollar, the pound versus the dollar versus the Japanese yen, the dollar versus the Swiss franc, the dollar versus the Canadian dollar, the Australian versus the dollar, and the New Zealand versus the dollar. If you can see a pattern here, they're always going to have the dollar in it. The dollar is obviously the one that is the most respected, the most valued currency in the market. It is the simple fact, and it is always going to be used against the next main currency pair. Now, some people sometimes ask, why isn't it USD versus euro? And this is just the way the market's set up. I don't have the answer to that question. Is there any point where they're actually flipped over? I'm going to be completely honest. No, I have never even considered that. But even if it were to get flipped over, let's say it's the USD versus the euro, it's still the exact same thing. It's just this time, instead of the dollar reflecting its strength while going down, it's going to reflect its strength while going up. Same thing for the euro. So everything remains exactly the same. This is just the way that the currency market has set it up. So these are the main currency pairs that you should be trading. And the reason why you should be trading these currency pairs is because, one, there's a lot of volatility in it, meaning that it is indeed going to give you lots of opportunities. Two, since there is a lot of volatility, that means that the costs to operate in these markets are going to be very low because people are moving constant funds inside of these pairs. So the cost to get involved is not that high. And on top of that, these tend to also be the trades that have the best moves in the right sessions. And three, these are the markets that tend to have the best moves. Now, when I mean the best moves, I mean that they actually have proper moves, because other currency markets that aren't as volatile or aren't as respected in the market, they tend to have the most random moves that cost people a lot of money, and it tends them to lose. Now, I'm not saying you shouldn't trade any other markets that are not these, but I'm saying that these markets tend to have the most respected moves. They don't tend to have these major spikes. They don't tend to have these unnecessary fees, which end up potentially taking you out of your stop loss when price didn't really make it there. These are all a bit more advanced stuff, and we'll get to that throughout this whole entire video. And I trade these other markets all of the time. I trade the most random markets. I'll trade the Canadian dollar versus the Japanese yen and find great opportunities there. But I just have to understand the risk associated with trading in those currency pairs. This right here are going to be the major currency pairs and the ones that tend to have the best price to actually trade, cost less, and have the best moves. So we'll break these down with the actual strategy and how to actually trade it later into this video. Okay, so now moving on to the next subject. Now that you understand what a actual currency pair is, and you understand that they're in a constant battle up and down, and that there is a never ending on this fight, and there's never a winner. There's just some streaks where one currency is winning, and there's another streak where another currency pair is winning. Now you have to understand that this battle, this fight has to be reflected based off of something. Like, we have to see the trail of this fight. When a currency pair is going up, it leaves a trail. When a currency pair is going down, it leaves a trail. Now we need somewhere to show us this fight. Now, this fight could be shown in many different formats. You can see this fight either in a line chart formation. You can see that the euro, for example, is getting stronger, then the dollar gets stronger, then the euro gets stronger again. So this is the line chart that is representing how this fight is going. You can also have this famous bar chart, which the bar chart shows whenever it's green that the euro is getting strong. Whenever the red bar comes out, that means the dollar is getting strong, so on and so forth. Then we have the candlestick chart, which is the most commonly known in the trading industry, which is where you have the green and red candles, and that is the representation of the fight. So there's many different types of charts, and all of these charts are representing the exact same price. This right here is Euro USD. This is Euro USD, and this is Euro USD. It's just representing the fight in a different format. The best analogy that I can give you for this is, for example, let's say Mike Tyson and Floyd Mayweather are going to be fighting. Now, you can either watch the fight in person, or you can watch the fight on TV, or you can hear the fight over the radio, or you can simply hear the fight over a headphone. Right? You're hearing, watching, you're getting the exact same feedback on the exact same fight at the exact same point. Every single point, whether it's on TV, whether it's in person, whether it's in radio, whether you're just listening to it, you're going to be hearing the same exact thing. Oh, Mike Tyson at this point was beating and knocked down Floyd Mayweather. Floyd Mayweather came back up, hit him with an uppercut, but then Mike Tyson knocked him out. Whether you are hearing that, whether you are seeing that, whether you are just listening to it, all of these are the exact same information of the battle of the currency pair up and down, just being represented in different ways. That's really all it is. And the most commonly known one is going to be the actual candlestick chart. The candlestick chart is where you're going to actually be able to trade off of the famous Japanese candlesticks and actually see patterns that constantly repeat themselves in a very effective way. These are going to be the markets that I'm going to be educating you guys on how to properly execute these trades and actually trade in these markets. The bar chart is not mainly commonly known for traders. It's used for a different type of style, which I'm not entirely sure how it works. So I can't explain something I'm not simply educated on. And if up to this point right now in my trading journey, I have literally not used it one single time, I feel like it's not necessary. I saw maybe 15 videos of this when I got started in my trading journey. None of them ever made sense. And I just simply wasted time and clouded my mind with information that I was simply never going to use and was not going to be effective in my trading style at all. So then I wasted time and not giving focus onto what actually mattered, which was the candlestick chart. That's what I'm going to do for you guys in this video. Tell you guys a little bit of what everything is, literally only focus on what matters and can remove the noise of what doesn't matter. Next, we have the line chart, which is equally important because this is going to lead you to understand the proper market structure on the time frame or on the market that you're going to be interested in. Have an understanding that this right here is like watching the real fight in real time. These candlesticks, these wicks, these moves down, this is like you're watching the fight in person. You're getting the sweat that is falling on you. If you're sitting first row, you're hearing the roar of the audience. Like, you're getting everything as real, as raw as it gets. No commercials. Everything is on the spot. Think of the line chart as if you were to be watching the fight on TV. And you might be asking, why? Well, it's because this only creates these structure points once the market has actually closed. Once a candlestick has closed, the next one has opened. Like, this doesn't really represent a move until it is completely done. I'm going to be breaking all that down in just a second, but think of this as the next step. So first you have the live, which is real raw fight. This is happening in real time. And then this, you get commercials. Maybe you have Maybe it might have a 15-20 second delay just because of the way it gets transmitted. But then after that, there is nothing else that is going to be important. We're not going to be using no bar charts, and we're not going to be using the scatter plot. Neither one of these are going to be useful. They're just a different way on how to represent the fight. I am not educated on it at all. I just wanted to show you different representations of how the candlestick chart looks compared to the line chart. So now that you understand that the only two types of charts that you're going to be focusing on is going to be the line chart and the candlestick chart, let me actually just show you guys how this looks like in real time, right? So let me just remove this right here. And let's actually go to the real markets. So right now, for example, let's say we go to Euro USD. So we're going to type Euro USD here on TradingView, and we're just going to go to a random Euro USD market. Now, don't worry if you don't know how to use TradingView just yet. I'm going to help you set all that up, but I first want to educate you on how the charts work. So if we were to click this section up here, you can tell that we have our bar charts, we have our candlestick line charts, we have our hollows. There's many different ways on how you can determine whether this market is going to get stronger or weaker with all of these different types of formations. So now that you understand that basically the difference between the line chart, the bar chart, and the candlestick chart is really just how the fight in between the currency pair is represented, let me show you this in a real time chart, right? So for now, we're just going to move this down, and we're going to head over to the top section over here of TradingView, and I'm going to show you the multiple different ways on how you can actually look at this fight. Now, don't worry, later into the video, I'm going to show you how to set up TradingView. Which one of these options did you actually be looking at? Because I get it, this can almost seem like information overload, but I'd tell you that maybe 50% of the buttons on this website you're never going to use, and the other half of it are very simple to use, right? So let's start off with the bar chart. So right now we are looking at BTC, or we can be looking at Euro USD, or we can looking at any single chart, right? So for us right now, since we're using Euro USD as the example, let's go to Euro USD. And as you can tell, there's many different Euro USDs. You have some on FXCM, on GBE, Oando, Forex.com, Kraken. Probably wondering what's the difference between this Euro USD and this one. And the only difference in between this Euro USD and this one is that it's on a different server. So this is the FXCM server. So this is a broker, and this broker gets certain data feeds, and it offers Euro USD at a different price. It's the exact same market. It's just offered maybe a couple of points higher, a couple of points lower. It's really the only difference. But for example's purposes, we're going to go to this one, right? It's all going to be the same thing. So right now, this is what Euro USD looks like on the actual bar chart. So if you notice, whether it's on a bar chart, whether it's on a line chart, whether it's on a candlestick chart, you're always going to have the price be at the exact same point, 1.17301. Now that is on the ICE server. If we were to go to a different server, which let me just type it in right here. So we have 1.1301. Let's say we go to capital.com. We have it at 1.1303. The exact same chart, it's just points are minorly up or down, and the chart might look slightly different, something that you probably like barely even notice. Just gonna have a little more structure points here, less structure points here. The one that I personally use is always going to be the Oanda server. So for me, the Oanda server is the most accurate. It's based off of one of the main US regulated brokers in the US, and it's the one that I personally use. For simple, I guess you could almost call it like a superstition reason, but I've never really used any other one. I'm sure I can use any other one. They are all pretty much the same. The points are off, not much. So back to the line charts, back to how these different type of markets work. We'll get into all of this different broker stuff, different markets, liquidities, and how this stuff works once we get to that point. But right now, I just want to explain to you the basic points, charts, right? So this is a line chart. So this line chart right here is exactly what the fight looks like in between Euro and the US dollar on the line chart. This is what the fight looks like on the Euro versus the US dollar on the bar chart. This is what the fight looks like on the Euro versus the US dollar on the line chart with markers. If you were to look at the area, if you were to look at the columns, if you were to look at the high-low, if you were to look at the volume footprint, I guess I don't have this option, but if you were to look at any other one, that is exactly how it looks. This right here is literally the exact same market movement. It's just the fight is being represented in different ways. The most accurate way and the cleanest way to look at the market and actually be able to develop a actual strategy and be able to predict patterns based off of how I've been doing it for the last 7 years, and I've been teaching people to do it, is based off of the candlestick. So we come over here to the trading view, and the candlestick is going to be the next one, the candlestick chart. Now I have a specific indicator, which is called a no gap candlesticks, which is very easy to apply. And I'll show you guys how to apply that right now, just so you can do it once we get to that point, but it'll be very easy. All you have to do is just go to indicators, type in no gap candlesticks. And I'm kind of getting a little bit ahead of myself here, but we'll just do it for now. You click on the no gap candlesticks, and then once you click on it, it basically pops up, and that's how you would implement the no gap candlesticks. Aside from that, I'll teach you to actually adjust it, because right now you're probably having an overlap with your actual candlesticks, and I'll teach you how to do that just a second later into the video, because I want to get into the indicators, and I also want to explain to you how this EMA works, why I use this EMA, which one is my EMA, so on and so forth. So the candlestick charts are basically consisted of multiple different time frames based off of these candlesticks. As you can tell over here next to the type of candlesticks that I have, these candlesticks are being represented in different time frames. For example, right now we are on the 4-hour time frame, meaning this candle right here closes every 4 hours. So this candlestick right here, the way it's being closed right now, has about 38 minutes left, meaning it has been open for 3 hours and 20 minutes nearly. This candlestick closed 4 hours ago, 4 hours ago, and 4 hours ago. This is what this market looks like based off of this 4-hour time frame. If we were to go to the 2-hour time frame, for example, this happens to be a candlestick once again that closes every 2 hours. So every single one of these candlesticks is 2 hours. This candlestick right here is the 1 hour, closes as well in 38 minutes, all because the market closes in the next 40 minutes. So a lot of these candlesticks are going to be closing at the same time. Next, on the 30-minute, this candlestick has 12 minutes left before this one closes. Every single one of these candlesticks is a 30-minute candle. Then we have the 15-minute time frame, which this candle closes in the next 12 minutes as well. All we have just done here from the 4-hour, or if we go up to the daily, or we go up to the weekly, is we are just looking at the fight from different points in the arena. So let's say you're actually in the fight, right? So we understand that there's different ways for you to watch the fight. You have watching the fight in person, which would be the candlestick chart. You have the line chart, which is like watching it on TV. And then you have the bar chart, which is like listening to it on the radio or having some headphones on, right? These are all the different formats for you to actually watch the fight. Now, we've decided that we're going to watch the fight in person because it's obviously the best one. You're there in real time. You get real updates and you're there live. There's nothing like being at a live fight. Now, where are you sitting in that live fight? Are you right there front row? Are you in the middle? Are you a bit higher on the stands, or are you in the nosebleeds? Which one are you? That's exactly what these time frames are right here. The higher the time frame, the higher you're going to be in the arena. The lower the time frame, the closer you are going to be to the ring. And you can get all the way as low to 1 second, meaning you can go to the 1 second time frame and you can literally see every single candlestick that closes every second. I don't have that feature unlocked here on TradingView simply because I don't use that feature. The lowest time frame I go is the 15, but with the feature that I have, you can go all the way up to the 1 minute, meaning every single minute a candlestick closes and you're going to be seeing every single one of those details. Believe me, you're never going to want to be this low into the time frames. It's just way too detailed. You can never actually see anything. And this right here is just a quick representation to give you a visual of what I'm talking about. So we've decided that we're going to go watch the fight in person. Now there's many different places we could be sitting. We could be at the skyscrapers, which this is going to be like the weekly time frame. We could be here in this middle area, which this is going to be the daily time frame. Then we can have this outer area, which this could be the 4 hour. This area could be the 2 hour. This area could be the 1 hour. And then this area up over here can be the 30 minutes. And this can be the 15 minutes. Speaking from personal experience, the best area to actually be sitting on these fights is going to be the weekly time frame. Now you may be asking, Alex, why? That's super far. Well, because from up here, you can actually see the fight. You're actually looking from the top down. The closer you actually get to the arena, you're looking at it more of a horizontal way. I don't know about you guys, but I wasn't blessed to be the tallest guy in the room, right? I'm not super short. I'm 5'9", 5'10". At these fights, everybody happens to be giants and everybody likes to stand in this area here. So if everybody's standing and they're taller than me, I can't see the fight. And the fight is on a platform. And since the fight's on a platform, guess what? not only can I not see because there's somebody big on top of like right in front of me, but then the fight is also elevated. So you're almost looking up. And if the people were to fall, for example, on this side, I can't see them at all. Like you're just not seeing them. You have to be looking up directly to the screen to see what's happening. So the point that I want to get to this is don't think the more detailed you can see stuff, and because something closes every single minute or every single second, that it's better because you get to see more details. That's actually completely false. You want to make sure that you can be watching and from above, and you can see everything from a higher standpoint, and you can almost see stuff coming because you're watching everything as it unfolds. So this is how going to the candlestick formats is, right? So we're looking at the exact same price, right? So if you notice right here, this is Euro USD on the daily time frame. It's 1.1314. If we go down to the 4 hour, it's the same 1.1314. Obviously the market's moving right now, so it's going to fluctuate one of these 2 points. But if I go down to the 2 hour, 1 hour, and the 30-minute quickly, you can see that it's all the exact same price feed. You're just looking at it in a much more detailed format. It's just being represented in a more detail. So this 4 hour candlestick right here that we are looking at, it's being broken down into 2 candlesticks when we go to the 2 hour time frame. So now it's going to be these 2 candlesticks right here. Now these 2 candlesticks are going to be broken down into another candlesticks once we go down to the 1 hour. Now these candlesticks right here, this 1 hour candlestick is going to be broken down to then another 30-minute candlestick once we go down to the 30-minute, so on and so forth. So what I'm trying to get you to understand here is that when you're looking at the candlesticks, because you go from this time frame to this time frame, doesn't mean you're looking at a completely different market, or you're looking at a completely different format. No, you're looking at the exact same fight. You're looking at the exact same market, just in a much more detailed way. And sometimes having those details is good. Sometimes having those details is bad. All that unfolds and it kind of comes together when you're actually executing a strategy and doing proper top-down analysis and executing it on the market. And I'm going to teach you guys how to do all that later into this video. Right now, I've just taught you what type of markets, how to break it down, and then the importance of understanding why these time frames are a thing. All right, so that's only the beginning of these time frames. Now, a lot of you guys may be asking, Alex, okay, cool, I get it. But how does the candlestick actually work? Like, what is this line up here? What is this line down here? Very simple. Picture, we can go down to the 1 minute time frame to see this as real as it gets. Picture this market right here as this candlestick right now is about to close in the next 2 seconds. It's going to close right there. And now another one is going to open from where this one closed. As soon as this next candlestick opens from this one that closed, it's either going to go up or down, right? It's really not going to do anything else. Now this market, as soon as it opened, it went up. Now, if this market in the next 42 seconds, it decides to not move at all, it will close like that. And then another candlestick will open right next to it, and it will either continue to go up or go down. But let's say right now that this market decides to have a push to the downside. There's going to be what is called a wick, which is that exactly right there. Once it actually had a little bit of a retracement, which will look like this. It's going to be a wick. That wick is basically representing where price has been. So for example, right there, you can tell price has been to that high point. So if I were just to get a line right here, that is the highest point the body of that move has been. And if this market decides to now have a reversal down and close to the downside, it will close with that wick. So in the next 2 seconds, we're about to find out if it's going to close with that wick or not. And I believe it has closed with the wick. Right now, since we're headed towards the closure of market tends to move, pretty slow. There's just simply not a lot of volatility. But this next candlestick should be opening right now. And as soon as it opens, it's either going to continue going up or come down. And this candlestick will officially have been closed with that wick. And you can see that this next candlestick just opened super quick, had to push to the downside. And now at one point it was down here. I just literally didn't manage to grab it because I was going back and forth in the time frames, but came down here and it went back up. Now this next candlestick, this one has closed here. This one opened, wicked up. Now it's wicking back down, wicking back up. So what this line is, what this tail is, what this hair, wick, whatever, the proper name is a wick. This right here is a wick, but many people have a lot of creative names for it. All this right here is just the history of where price has been. So right now, this candlestick is currently creating that wick right now. It's currently creating that high, created up to that point. And if it closes right here, that is where the trail of the candlestick has been. This is the market showing us how the market is moving. Is it moving very aggressively to the upside? Is it rejecting this area? Because this wick right here is shown as a sign of a rejection. Clearly price was bullish, or this candlestick was completely filled all the way up to this point, but something happened in the market that it pushed it down. In turn, that should then mean that it should continue to be pushed down. For example, that closed with a small wick at this area. So that means that the sellers aren't as strong, but now we have very strong sellers coming into this area now, for example. So let's say this market closes with the wick all the way down here now. And you can see how this market can, wow, this is, moving very aggressively, but this is showing you guys how the markets can move, how fast it can move, even though we are in the last couple of hours of the markets. This right here, if it somehow reverses and it has a push to the upside, then this would have a very big wick, right? It could look something like this. But see, this right here is continuously pushing down this market. And if wherever it closes, this wick is doing the trail of where that market has been. Now that wick is equally as respected when it comes to the 1 minute time frame, 15-minute time frame, 1 hour time frame, daily, 4 hour. These are all different types of wicks that are being created. So as you can tell in the 1 minute time frame, that might have looked like a massive bearish candlestick, but you look at it right here in the 4 hour, and this 4 hour looks pretty much exactly the same from when we started talking about this subject a couple of minutes ago. So that's why the lower time frames, it might seem like a very big wow move, but in reality, it doesn't affect any of the higher time frames. Are the lower time frame used in order to determine a trade, and do they go in sync with the higher time frames? Absolutely. But there's a way, there's a time and a place to actually execute that correctly. But if you can tell, that 1 minute big bearish candlestick looks like it might have had this fall off a cliff. But then when you go look at it back to the 4 hour time frame, this literally looks exactly the same from when we actually started trading. But I just want you guys to understand what these wicks are. That means that the market at one point, it was a completely bullish candlestick into this area, and then something drove price all the way down, and then it ended up closing here. Once it closed here, this candlestick opened, had its move up and down, created that history. This is where this market closed. Then this one opened up, had its history, it closed, and then this is where this one opened up, had this push up, and as of right now, it's right here. And the next 24 minutes, this candlestick will close, and then another one will open and either have its push up or down, or however it ends up closing. But once one candlestick closes, another one opens right next to it, and this will be the never-ending battle of the market. And our job as traders is to determine what that next move is going to be, and us capitalize off of that move, because these market opportunities and this battle is a never-ending battle. All right, so now moving on to the next subject. Now that you understand that the candlestick chart is like watching a fight, that is the way that it's being represented, and the closer you are to the arena, which is the lower the time frame you are, means the more precise you're watching the fight. The higher the time frame you are, the higher you are actually watching the time frame, but you're watching the exact same trade, you're watching the exact same market, you're watching the exact same fight. It's just being represented in a much more detailed format. Euro USD, you could be watching on a daily, 1 hour, 30 minute. You're just looking at it in a much more detailed format. And now you know what those wicks are and how the candlestick leaves those trails, so on and so forth, right? But I want to explain to you now the actual trading sessions when it comes to the strength of the time to actually be watching that fight. When is the right time to actually be there and be involved? Because if not, because, to be honest, you can't really be involved 24/7, even if you wanted to, because you're going to be there at times where there will simply be absolutely no volume, where you're just going to waste your time and the people are going to be tired, right? So the best way I could put the analogy, and I love my analogies sometimes, but I feel like they're just too precise that I forget to go back to trading. If people are fighting, there's going to get a point where they're going to get tired, right? And if they're tired and, they're drinking water, they're stretching, they're eating food, that's pretty boring, right? You want to see blood. You want to see somebody get knocked out. You want to see somebody lose a tooth. That only happens at specific times. That's after they rested. That's after they're well eaten and they're actually ready to fight. And that only happens at specific times, right? That's exactly what I'm talking about in the market. Yes, you want the market to have these big, massive moves to the upside, these big swings, and you want to catch these big trades, but that doesn't happen all the time. Like, the market gets tired. The market has movements at only specific times. So these are the highest volume sessions, and then these are the slowest volume sessions. So we're going to start off with the Sydney session. So we have Sydney session and Tokyo session. So this tends to happen around 5 to 6, 7, 8, 9, 10, 11, 12 EST. So this is basically the afternoon. This is when people finish their 9 to 5. This is all of the afternoon. And as you can tell, the lighter the color, the less the volume session. The darker the color, the more session there is. This right here is exactly when the fighters are taking a break. They're stretching, they're eating, they're cleaning up their sweat, they're closing up their wounds, they're taking a break. So if you are in front of the arena at this time, you are simply watching nothing. Yeah, they're going to be there, cleaning up one another. They might be talking smack back and forth, but they're not fighting. You're not going to see blood, right? Because there's no volume. You can be in front of the markets at this time. Yes, it's going to be moving. It's going to be creating little moves up and down like this, exactly how I just showed you. But you're not going to have those big swings. Why? Because there is no volume. There is no volume in Sydney session or Tokyo session. There is absolutely no volatility there. Is there a one-off moment where there could be a quick pump that happens there? Yes, that can be 1 in every 20 trading days. But are you going to be in front of the arena knowing that 1 out of 20 trading days, one guy might just get up and sucker punch the other guy? Probably not, right? You don't want to bet your money on that. The odds of that happening are unlikely. Just whenever it happens, you'll watch the video and it pops up, and then usually they'll go back to fighting in just a couple of hours. Is there going to be a time where you're not looking at the markets in these sessions and it has and moves? Yeah, sure. But that wasn't your time to be watching the market anyways. So Sydney and Tokyo session are going to be the sessions that you are not going to be trading. You're not going to be interested at executing any trades. I use these time frames right here to go do stuff with my life. I go and work out. I go and try and have a life that's not just staring at the charts. Beginning of pre-London session, and then we have all of London session. This is when the battle begins. This is where things start getting very, 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 very rough. Now, I would argue that this chart is a bit inaccurate. I'd say this could be a little bit darker, maybe a little bit more this way. But this right here begins from 1 in the morning. So at 1 in the morning, I start doing my pre-London analysis session because London session opens right at 3 in the morning. And pre-London, which is 1 a.m. to 2 a.m., there already starts to be some volatility and the market starts to move very well. Then you obviously have all of London session, which lasts from 3 in the morning all the way up to around 12 p.m. EST. Now, there's something beautiful that happens inside of the currency market at this point right here. And that is that the New York session happens to open up in the same time that the London session is ongoing. So London session opens up at 8 in the morning and it overlaps the London session, creating this extremely volatile point in the market. So I like to enter my trades either pre-London session or during London session. So then the trade has good volatility. It starts going in my direction. And then once New York session kicks in, it just adds more fuel to the fire, which ignites it even more and gives it more of a movement. And then typically right around the ending of London session, halfway through New York session, the market starts to slow down again. And then things start to just not get any volatility. The market takes a break for a couple of hours, and then the pattern repeats itself. This will repeat itself from Monday to Friday every single day. Now, the key point here that you need to understand is that there is realistically only a window that you need to be involved into the market. You can only get involved in the market from 1 in the morning all the way up to around 10:30 in the morning. And some of you guys may be asking, but wait, Alex, there's still some volatility over here where the New York session and the London session overlap. It's like, yes, correct. Yes, there's still going to be some fights going down here. It's still going to be aggressive, but it's headed towards the end of that. And you don't want to enter a trade while it's being extremely volatile. And then what ends up happening is that it slows down for the next 10 hours. Because let's say you enter a trade at around noon, right? You're not going to be having any volatility for the next nearly 10 hours. 1, 2, 3, 4. We have 10, 11, 12, 11 hours. You're going to have absolutely no volatility in your trade. Does it make sense to enter a trade that is not going to have any movement for the next 11 hours? Not really. And you're going to pay an unnecessary fee once the market closes and then opens up again, because every single day at 5 p.m. EST, the market closes, opens up literally for like 1 minute. And then what ends up happening is you have to pay a swap. You have to pay commission fees for holding trades overnight. And it just not only does it cost more money to do that, but then you just have trades that are going to be in the same point for the next 11 hours. And there's nothing more than I hate than looking at my money do nothing. Right? I either want my trade to hit my stop loss or hit my take profit right away. I don't want to be in the same exact point with the market just being stale for the next 11 hours. So you want to enter the trade either right before the session starts to kick in, either right in the middle of London session, right before the real batter starts to kick in, inside of that battle, or right before it starts to drop off. You can enter a trade anywhere 9, 10 in the morning, and then you can catch the ending of the overlap of London and New York session. Anything after 10 in the morning, I have not taken a trade after that time. I can't even remember. I think it's been 4 years since I have taken a trade past 10:30 in the morning. Now, once again, is there going to be an example? Is there going to be a 1 out of 20, 1 out of 30 probability that the trade that you would have taken at, let's say 12 o'clock, it actually ends up hitting your take profit by 8 p.m.? Sure, of course, there's always going to be these one-off opportunities, but that is not how you build a sustainable, profitable strategy that is a strategy that you follow time and time again. This is something that is proven system that it simply just works. You get involved before the session kicks in, either right in the middle of it, in the middle of the peak over the overlap, or right before the ending session of that. This is what's led me to have my biggest trade. I think my biggest trade is like $500,000. This is what led me to be able to have that trade. This also led me to be able to avoid many losses, because if you are only focused in trading about, let's say 6 or 7 hours out of the whole entire trading day, you're really only focused on a very specific time right here. And I know this tends to be an issue because a lot of people tend to be at jobs anywhere from, or either at jobs or sleeping from 1 in the morning to about 10 in the morning. Like, this is a crucial time right here. But I will tell you this, the sacrifice is definitely worth it to be involved in between these time frames right here. From 1 in the morning to 10 in the morning, EST is the most accurate times for you to be trading. Anything outside of this time frames right here, I could guarantee you will not have anywhere near as much volatility. It just simply does not happen. The two big banks are going to be closed and you're just not going to have enough volume. And this goes especially to the markets that have the US in it. Any markets that have the dollar, for example, let's say you're trading Euro USD. If the dollar is asleep and the banks are closed, how do you expect for that to have any movement in this session over here? So this goes specifically to those markets like GBP USD, Euro USD, anything that involves the USD. If the USD market is asleep or it is not open, it's not going to have any volatility. Can you still trade USD markets in the London session, because technically the London session hasn't opened? Yes, actually it's even better, because let's say you trade Euro USD or GBP USD. You're trading the pound right when the market opens over there. And then when New York session opens, you get double the volatility with the same exact currency pair. That right there is the golden ticket to having the perfect moves. Now, you obviously need to align that up with a strategy. You need to know what you're looking at in the charts. Just because it's 1 in the morning, you can't just click buy or click sell and expect to make money. Can you get lucky? Sure, but that's not, once again, how you have a sustainable income while you're trading. So to sum things up, yes, the markets are open 24/5, and technically you could go and execute a trade at any one at those hours. You can literally go and hit the buy or sell button at any time you want. But there is going to be a high chance that if you are not in the correct session, that you, 1, are going to pay unnecessary fees, and 2, you're going to be stuck in a volume that is going to simply have no movement. I want to make sure that I can enter a trade when there's going to be a lot of movement, and the odds of my trade winning are going to be a lot higher. So this right here is the currency market trading session, and this works for every single currency per hour out there, whether it is AUD JPY, USD JPY, Euro AUD. Everything is always going to fall inside of this trading session right here. That is going to be the session that is going to create the best movements at any given point. And the key of it is so you know how to put that together with a profitable strategy. And I'm going to be teaching you that in the next couple of hours. All right, so now moving on to the next subject. Now that you understand that you actually need to be trading in a proper session and where you need to be in that fight, you got to make sure you're there at the right times. But now you're probably asking, all right, Alex, I get it, but what do I need in order for me to actually go and execute a trade in these markets? What do I have to actually do so I place a bet on the fight? I think I got the potential fighter that I think is going to win for the next couple of rounds. What is the actual platforms that I can go and execute that buy position or that sell position? Well, it's actually very simple. You realistically just need these 3 platforms right here. So the first platform that you're going to need is going to be TradingView. So TradingView is what we've been on pretty much this whole entire time. TradingView is where the actual charts are going to be represented. TradingView is where you're going to analyze the charts and determine if you want to either buy or sell the market. TradingView is where you're going to do your top-down analysis where you're going to mark up your charts. This is where you see all these traders with these fancy lines, you see them with these boxes, you see them with these wins and all of these losses. This is where you're going to see traders with drawings and where they analyze their trades and have notes based off of what type of trade they're executing and where it meets their strategy. So once you've analyzed here on your actual charts that you want to determine that you want to buy or sell a market, you then need to go to a broker. So let's say right here, you've been watching the fight for the last 5 minutes, 10 minutes, and you're like, you know what? I see Mike Tyson that he's strong. I see Floyd Mayweather that he's weak, or vice versa. And for you to go ahead and place that bet, you have to literally get up from the fight and you have to go to the betting station at these fights. You go ahead and place your bet, and then you go back down and then you watch the fight. This is pretty much the exact same thing. So on TradingView, you're analyzing your charts. You determine that you want to bet that the euro is going to get stronger than the dollar, or that the dollar is going to get stronger than the euro. So you get out of TradingView and then you are going to go to a broker. So a broker is where you're going to go ahead and give them the money, and then you're going to execute your trade based off of what you want to do. So I recommend many different brokers. One of the brokers that I recommend is going to be LQH Markets. This broker accepts traders. They have a 1 to 500 leverage. You can start off with small $10 deposit. They have many different types of accounts that you can go ahead and use with them. And another, just in case if you don't like LQH Markets for whatever reason, I also recommend 1xTrade. This is another platform or another broker that I would recommend. Also, pretty cool features of them is that they have these lot size calculators where you can pre-calculate your risk on your positions here, and I'll explain all of that in just a second. But basically, once you were to deposit your funds into the broker, now can you actually go and execute the trade on the broker? The answer is no, you cannot. For you to go ahead and execute the position, the broker is going to then take that position into a marketplace. So this right here, what the broker does is like the middleman from the real marketplace. So there's a real marketplace / liquidity. And us as retail traders, as we are, even including myself, whether it's my experience or how good of a trader I am still a very small fish inside of this industry. So what the broker is going to do is the broker is going to take your funds, and whenever you place a position, then they're going to go ahead and then feed it to the real market, because then the real market is going to then feed it back into the broker. So what the broker is, it's like the middleman of the real markets. So whatever you're seeing here in the markets, which is, let's say 1.17312, they get that offered at a different price. Let's say they get it offered at 1.7300. So what the broker is going to do is they're going to charge you a spread. They're going to charge you a fee for them entering that position into the real market for you. And that's the broker game. Some brokers charge you higher fees than others. That's why I have 2 of them, because sometimes these fees range. Some of them charge fees for holding positions every single day, because they are the ones that are going to go ahead and actually execute your trade into the real market. And then based off of your results, whenever you decide to close your position, whether you win or lose, the market feeds it back to the broker, and then the broker feeds it right back to you. The broker is the middleman for you to get access to the real markets. You cannot get access to the real markets without a broker unless you're a bank. And I right now have no possibility to be a bank. You need tens of millions of dollars for that. You need proper licensing. And truthfully, I rather pay the broker the couple bucks that it takes for them to connect my trade into the market. It makes things far easier. Now, you can't go ahead and execute the trade on the broker itself. The broker is like the bank. So picture this right here as if it were to be Chase Bank, or as if it were to be Wells Fargo. Now, when you go send money from Chase Bank, or whenever you go pay somebody from Chase Bank to Wells Fargo, you're not going to be paying them via Chase Bank. You're going to be paying them either PayPal or Zelle or Stripe. It's going to be a payment processor that's going to process your payment to somebody else. Can you do a wire transfer? Can you do all of these other stuff? Yes. But we're going to use the example of using these third-party merchants that actually send the money back and forth. So when you go to the broker accepts your funds. And then when you're going to go ahead and execute a trade, which is going to be like sending money, you're then going to use a platform called MetaTrader 5. So MetaTrader 5 is going to be the platform that you are going to actually execute your position on. So you first go to TradingView. You determine if you want to enter a trade or not. You deposit funds into the broker. The broker's like a bank. You can just have funds in there just chilling. And then whenever you're ready to go ahead and execute the trade, you go to MetaTrader. So once you deposit money into the broker, you pretty much skip the broker every single time, because you just go from the charts straight to the platform to go ahead and execute the trade. Once you are in TradingView to execute the trade, simply click buy or sell. That's pretty much it. So here based off of your analysis that you did on TradingView, you're going to go ahead and then execute the trade at this point. So simplest analogy that I can put is you're watching the fight. After the fight, you go to the little betting station at the arena. And then from that betting station, they're going to give you a little piece of paper. The little piece of paper is your slip that you've just betted on. And this is basically what your slip is going to be. So this is where you're going to be able to see if your trade is in profit, if your trade is in loss, and whatever directly is reflected off of MetaTrader 5, then it's going to go right back into the broker. So no money is ever inside of MetaTrader 5. MetaTrader 5 is just a platform that represents the positions that you've actually executed on the broker. Some brokers offer MetaTrader 5, some brokers don't. Doesn't really matter if they do or if they don't. This is just simply one of the actual ways for you to execute the trades into the market. There is hundreds of different platforms for you to execute trades in the markets. There's hundreds of different brokers out there, and all this platform really does is just the most commonly known one and the one that I personally use. This is just the main known one for you to be able to go ahead and execute those positions on there. So this MetaTrader 5 is never, like, this is not a broker. This is just one of those payment processors. If you go ahead and try and pay somebody with PayPal, you can go ahead and then use Stripe. If Stripe doesn't work, you'll use Zelle. If Zelle doesn't use, you try something else, right? It's a different platform to just execute the trades on. But the money will always be inside of the broker. It's just reflected on this platform right here. Basically, win or lose, money then goes back into the broker, and then there you can decide to withdraw, take it to your bank, take it to an exchange, take it to wherever, and then you simply just withdraw your funds. So these are the only tools you are going to need for you to actually be able to be ready to take a trade. You analyze the markets on TradingView, then you go ahead and have your broker of choice. I recommend both of these brokers. Is there hundreds of other different brokers out there? Yes. I personally like these two brokers simply because they offer higher leverages. And for the type of account flips that I personally do, I've taken very small amounts of money to very large amounts of money. It's very hard to do that on heavily regulated brokers, simply because if something is heavily regulated, they will not allow that high leverage. And I would much rather have my funds on a broker that lets me have more access to my funds, and I'm able to actually leverage it more. So that's what these two brokers offers. Trusted brokers, in my opinion. I've been using them for a very long time, and they're not the best ones. I'm sure there's others out there that offer different fee structures, different commission structures, and I leave you to go ahead and do your own due diligence on it. But these are the both brokers that I recommend and I have been using for some very long time. And then same thing with MetaTrader 5. Is MetaTrader 5 the end all be all platform where you can go ahead and execute your trades? No, there's hundreds of different trading platforms out there that you can go ahead and execute your positions on. MetaTrader 5 is just the most commonly known one that everybody's probably seen it. This is like a PayPal. You're going to send money from one friend to another. You're going to do it through PayPal. And if not, it's a different one. At the end of the day, what matters is that the money is sent through. At the end of the day, what matters is that the trade is actually executed. And that's pretty much it. Now, if you want to withdraw your funds in crypto and then you want to take it from crypto to your bank account, there's many different exchanges. You have the biggest ones, which are Coinbase, you have Binance, you have Kraken. There's many different exchanges that you can go ahead and send those funds to. And then from there, you take it to your bank. Now, how can you deposit into the brokers? These brokers take credit debit card, or they can send them BTC, crypto, however you want. So it's however you want to deposit the funds into the broker. But these are the only trading platforms you are going to need for you to be able to execute a trade successfully. There is hundreds of different other platforms out there, right? There's hundreds of different other web links, hooks that you can add, but I guarantee you, you do not need anything else aside from this right here. This is my window of trading, and these are the only tabs that I will ever have open. My TradingView, the brokers that I use, my checklist for my strategy, my community, and last but not least, Forex Factory. Forex Factory, as you can tell, is the last one on my list, not because it is the least important, but because it is the one that I potentially use the least. And that is because this right here is a fundamentals tab. So Forex Factory is mainly driven by fundamentals. So as you can tell here, if we were to click on the calendar section of Forex Factory, we're going to have all of these potential impact news that are going to pop up. And as you can tell, what we have is, if I were to just go back one time, this lets us know the exact date and time when news are going to come out for a specific currency. And the color of this folder is the importance of it. So something that is a red folder is far more important than something that's an orange folder. And obviously we have yellow folders and then gray folders, but I simply just don't use them because they obviously are very slightly like they don't impact the market at all. So I always like to focus on the red folders. But this is the only other platform if it causes any possible curiosity for you to understand the fundamentals. And I'm going to break down the difference between fundamental trading and actual technical trading later on into this video. But this is the only other platform that is going to be needed. Here you can literally see what the forecast of the fundamentals are going to be, what it was previously, and then what it actually was. And as you can tell, for the majority of the part, it really is never that much off. And these doesn't really create any big impacts into the market. These are all very minimal. Even the big red folders don't really have a big impact on the market. It happens occasionally, but it's not a way for you to actually create a profitable strategy. So these are the main trading tools, the main trading platforms that you're going to need. The last but not least will be forexfactory.com. That is just for you to understand the actual fundamentals of the trade. Aside from that, you do not need any other trading platforms. You do not need any other tools. You don't need anything else. All you need is just your trading view. You need your broker, and then you need the platform for you to actually execute the trade. And that is it. So now taking this a step further, I'm going to actually show you guys how to create an account on a broker and how easy it is to deposit into it. So right now we're watching the fight. Euro USD is going up and I see that Euro is going to get stronger. Let me go ahead and buy the Euro. So we're going to put the example on onextrade.com. So go to onextrade.com. I created a random demo account, just use a random email. And this is the portal inside. So some people sometimes get tempted or some people get skeptical by this, but it's a very easy process. It's a very seamless process, right? So right here, as you can tell, it's a brand new account. There's no real transactions. There really isn't anything. Dashboards are super simple because everything is straight to the point. All this is right here is like a bank. The money is going to reflect here, how much you deposited, how much you've profited, and how much you've withdrawn. Very simple. And where you see the actual trades, where you see the actual P&L, all of that is going to reflect on MetaTrader. So we're going to go one step at a time. So right here we have onextrade.com. This is the dashboard. And let's say we want to go ahead and deposit some funds. For us to deposit some funds, we need to go ahead and create an account. Once we create one of these accounts, we can pick from either a standard, a commission-free, or an expert account. For this example, we'll just go with the standard. The difference usually tends to be minimal. And we're going to go with a 1 to 500 leverage, right? Very easy, very simple. This is the max leverage that they offer. I'm going to explain what leverage is later on into this video. So I want to go one thing at a time. So right here, as you can tell, we have created a account. So now we have 1 to 500 leverage, we have $0 balance, and we have 0 equity into our account. So for us to go ahead and actually deposit it, we click quick deposit up at this top section over here. Now we have the option to deposit in crypto, or we can go ahead and deposit in credit card. So this is a much faster process and it can be done in the next couple of seconds. I'm just going to use crypto and we're going to go ahead and click on this account, make sure that we have crypto as our option. We don't have a promo code, but we are just going to place a basic $100 deposits into this broker. Minimum is 10 bucks, but I'll do $100. Promo codes, if you have any actual, credits, use promo code Alex, for example, you get an extra $100. Not saying that's a real thing, but sometimes they offer promos for that stuff. So let's say we click deposit into the trading account. I can deposit in Bitcoin, Litecoin, Ethereum, Tether, or USDC coin. We're going to use USDT ERC20 for this example. And this is the actual wallet address. So I'm going to head over to my phone and just send a quick $100 just to show you guys how simple this is. So right now I'm sending the funds from my cold wallet into this platform. So just waiting for this to load. Some people don't have a cold wallet. You guys can use credit debit. Usually takes a little bit longer because, the processing has to go through. Crypto tends to be pretty quick. So I've already sent it over. Should pretty much reflect into my P&L here. Pretty simple. Once payment is confirmed, they will be reflected on your account. Cool. So we can just go back over to our dashboard here and pretty much just give it a couple of seconds and it should pop up pretty quick. And as soon as it pops up, I'm basically going to log in over here to my MT5 account on my phone. And then we're going to see how that is going to be reflected then. So let's give it a couple of seconds until the balance pops up. All right, so quick update. About 7 minutes later, $100 got here. This is probably like the part where a lot of people get sketched out. Sometimes you just have to let the crypto do its thing. It takes time. It's part of the process. Usually it takes, 1 to 2 minutes. This time it takes 7 minutes. I guess it's because it's near market closure. I don't know what the case is, but The funds are now here, quick $100. So picture this as if this were to be like the bank, right? So the funds are now in the bank. Now in the bank, you can't actually go and send any funds out. You have to connect it to PayPal, which is going to be MetaTrader. And then you connect your funds to MetaTrader and you can go ahead and execute the trades and send the trades out to the markets. You want to send these funds out to anybody. Now it goes from this bank, you connect to PayPal, and then you can send it to whoever. So we come here, we click on view. You can tell that we have the MetaTrader 5 account. We have a standard account. This is my account number. All I have to do now is go to MetaTrader. And when I go to MetaTrader, I search up the server. So it's 1xTrade server. I click on the server. I then put on the account number, put my password, and I'm pretty much logged in. As you can tell, this is a brand new account. There's literally no history on it. There's no anything, right? We can go to transactions. We can go to everything. You can tell the $100 just got completed literally 7 minutes ago. And I'm going to log in now to TradingView. I'm going to log in now to MetaTrader so you guys can go ahead and see how that looks in that option right now. So the money's in the bank. Let's now go to the actual platform where we're going to execute the trade on. All right, so now that we have officially logged into our MetaTrader on the phone, this is what it's going to look like. So I'm just going to screen record here on my phone. They'll probably put half the screen, the MetaTrader, half the screen myself. So basically over here, once we are actually inside of MetaTrader, so we're going to have 1, 2, 3, 4, and then 5 buttons all the way over here at the bottom. As you can tell, this is the server that we are in, 1xTrade. And you can tell this is the exact same account number as you can see over here on the actual back end or the dashboard of your account. You can tell it's 820838. So once you go to the dashboard area of this area and then you create a new account, it automatically creates a brand new MetaTrader account for you. They send you the login password directly to your email. Now all you have to do is log in. Once you log in, the money gets deposited into here and then it's going to reflect onto here, which is going to be the balance area of the MetaTrader 5. So the middle section is where you can actually see your balance. You can see the equity, the free margin, which is where the trades are going to be fluctuating up and down. The button next to that is going to be the history button. Here you're going to be able to see how much money you've deposited into the platform. You can see the pending orders, deals, everything, right? So this is basically the history of the account. Obviously, we've only deposited $100. That's all we're going to see in this account. Settings option, everything here is pretty self-explanatory. This is just kind of the settings of the MetaTrader 5. You'll never realistically use this unless you're going to create a brand new account or log into a different one. The chart area, this is where you can actually see the chart of the price that you are going to be trading or the market you're going to be trading. For example, let's say we were looking at Euro USD. We go over here to the quote section, which is going to be the last button all the way to the left. And let's say right now we're trying to trade Euro USD, for example, and it's not reflecting. All we have to do is just type it, search up Euro USD. Once we click on it, we can just click answer after, and it's going to add it all the way at the bottom over here. Now, if you want to see the chart of Euro USD, we just click on it, click on the chart option, and then it'll take us to that second button once again. And then we're going to then be able to see TradingView. So if you notice, this TradingView chart right here is the exact same TradingView chart that we are going to be looking at over here. As you can tell, price feed is nearly the same. Right here, the market closed at 1.17312. And right here on the actual 1xTrade server, the price feed is going to be 1.7370 and 1.7340. So on TradingView, we get the real raw price. Now here on 1xTrade server, we get the marked up price. So this is where the broker is just charging a bit of a spread for executing us into the markets. It's part of the game. It's inevitable. You have to pay the fees. Whenever you send money through PayPal, whenever you pay for anything, there's a very small fee involved. It's part of the game. You want to get access to whatever it is that you're purchasing, you have to pay the fee. So here's where you're going to be able to see all of the markets that you are actually executing in the market. So you can add as many markets as you want. You can go ahead and delete as many markets as you want. Pretty easy, pretty user-friendly. Everything is pretty self-explanatory. You should realistically only be spending maybe 5% of your time on MetaTrader because all that you do on MetaTrader is simply just execute the trade. You're not ever actually analyzing the markets in this chart section as you would be doing on TradingView, for example. TradingView is where you actually break down the chart, make the trade make sense, and if you're interested in entering the trade. Now, on back to MetaTrader, this is where you actually go ahead and execute the trade. After you execute the trade, there is no reason why you should just be looking at the money going up and down. What you should be doing as a trader is looking at the charts, seeing if the trade makes sense, if the market is moving in your favor. And then obviously whatever the charts are doing is going to reflect on your profit and loss right here on MetaTrader. So over here, all the way at the far left section, once again, where we have the quote section, we have the option to go ahead and enter the trade, which would be the first option once you click on that market. You have the option to go look at the charts. You can look at the trade details, or you can look at the statistics. I'm going to be completely honest. I've never clicked on this details option. I don't know how to use any of these options right here. These are just some details of the currency pair. I don't know what any of this is. I've never used it, but it has that feature. And then you also have the statistics, which it shows all of this right here. Once again, I have absolutely no idea what any of this means. I've never used it in my life. All I know is that I use the one option here, which is to go ahead and enter the trade into this market. Now, this button to enter the trade into this market is going to have multiple different options in here, right? So you can go ahead, either tap on that button and hold trade, or you can go ahead and swipe it to the right and then click plus. And that is also going to give you the option to go ahead and execute this trade. So all the way at the top, you can tell that we are trading Euro USD. If you want to swap it for whichever currency, you can go ahead and swap it for Euro CHF. You can swap it for Euro CAD, but we're going to be using Euro USD. Back here at the Euro USD, the button under the market that we're going to be trading, you have the option to do either a buy limit, a sell limit, a buy stop, a sell stop, a buy stop limit, and a sell stop limit. All of these are different limit orders that you're going to place on the market. And I'm going to explain to you what those limit orders when we actually get into the charts. But I personally myself, I have never used neither one of these limits. I've never used a buy limit, a sell limit, a buy stop, a sell stop, a buy stop limit, or a sell stop limit. These are all just orders that you place in the market. So let's say, for example, I want to set a buy limit on the market. I want to buy this market once it gets to X price. I want my stop loss to be at X area, and I want my take profit to be at X area. That's basically what it is. It's like you're going to set a price into the market, and whenever the price gets there, it automatically enters that trade for you. That is a style of trading. I am not against it. I just personally don't believe in it, simply because you're entering a trade without confirmation. You need to enter a trade once you actually have a proper entry signal, once it meets your actual trading plan. And I'm going to teach you how to do that later, that into the video. But these are multiple different ways on how to actually execute this trade. Now, the simplest one is market execution, which is going to be the one that you're going to use 99.99% of the time, which is you just simply place your stop loss. You simply place your lot size. And on this lot size here, you can make it 1 lot, you can make it 2 lots. And a lot of people get confused on this whole lot size position calculating, and it's actually very easy. So this lot size here has to be directly predetermined before you enter the trade, so you know exactly how much you're risking. That goes based off of your stop loss and how much you're going to have on your stop loss. So let's say, for example, you're interested in entering this trade as a sell, right? Just for an example. Or you know what, we'll do a buy. It's a lot easier to understand a buy. So we have a buy example on this market. Our stop loss is going to be, let's say, 20 pips. I'll explain what pips are and how all this works in just a second. But let's just say it's 20 pips. And our goal right here is to figure out what our lot size is. Right? So we're going to, for us to determine our lot size, we need to first determine how big our stop loss is. So we're going to go to 1xTrade, LQH Markets, whichever one. They both have this lot size calculator. You're going to put the balance amount that you have on your account, and then how much you want to risk of your account. Let's say we want to risk 1%, right? And then our stop loss is, or say we want to risk 10% of our account, and our stop loss is 20 pips, and the currency pair that we're trading is Euro USD. All we have to do is just click calculate lot size. And this lets us know that we have to put a 0.05 lot, which is risking a total of $10. So we know that if we were to go back over here to the actual MetaTrader where we're going to execute the trade, we have to place a 0.05 lot size. And then our stop loss number needs to be exactly what it is right here on the chart. So our stop loss number would be 1.17096. So it'd be 1.17096. And then our take profit would be where we set our take profit up here. It's going to be 1.17, maybe 1.1715. So now at this point, we are pretty much ready to buy this market. We could go ahead and then click on that buy button. And we know if we are completely wrong on this market, so we know that this is our stop loss, 1.17096, and this is our take profit, 1.17715. If the market goes straight into our stop loss, we are not going to blow our account. We have a stop loss, which is going to minimize our loss, which is at our predetermined risk, what we have just calculated on this lot size calculator. So now at this point, the fear of people thinking that I'm going to lose all of my money when I put money into a broker or whenever I go trade is gone, because you're only risking $10 from your actual trading balance. So if this can go to your stop loss right away, you've predetermined you're only okay with losing on this position, $10. So obviously if we would want to enter this trade, we would go ahead and then click buy. But obviously the market is closed. The market just closed nearly 30 minutes ago. But as soon as we would enter this trade, it would be reflected right here on this actual area. And right here, you're going to be able to see your trade fluctuate up and down. And then you can go over here to this area and you're going to be able to see your stop loss. You're going to be able to see your take profit. You're going to be able to see the trade be reflected in real time. And you're going to notice as soon as you enter the trade, you're going to be an immediate drawdown, right? So you're probably going to be in a loss, maybe a couple bucks, right? $5, $6. And that's because the broker, as soon as it enters you into the market, they don't care if you're going to be in a winning or losing position. They're going to charge their fee. They don't care if you're going to be on the right or wrong side. They have to get their profit first for them to go ahead and execute your trade into the market. So they get your trade, they're going to put it into the market, they're going to take a small fee from it, and then your trade happens, whatever happens with it. Win or lose, the broker's always going to make their money. That's just the name and the game of the business and how it works. So once again, you have your TradingView account, which is where you're going to analyze a trade, determine if you're going to buy or sell a market. Once you're ready to enter this trade, you need to go ahead and deposit some funds into the broker. Once you have your funds inside of the broker, you need to then actually go to then MetaTrader, which is then going to be this right here. On MetaTrader, you're then going to go ahead and then place that buy or sell button. That's pretty much it. Now, whenever you win your trades, you come back over here to the dashboard area of 1xTrade, and then you're going to head and then quick withdraw your funds. Now you can withdraw your funds to whatever wallet or however format you choose to withdraw your funds, and the funds go back from the broker into your bank account. And that's it. Very simple, very seamless process. These are the 3 platforms that you're going to need to actually go ahead and be able to execute a trade into the market and be able to successfully have a profitable strategy. So now coming back to the charts, now that you understand exactly that you only need 3 platforms to actually trade into the market, you need the TradingView, you need the broker, which is like the bank, and then MetaTrader is where you actually execute the trades. Let's take a step back to actual TradingView, right? TradingView is going to be, once again, like where everything goes down. So I'm going to explain to you how trading works, all of the different options within TradingView. So right now we are on TradingView. As you can tell, we are on tradingview.com. This is basically where you're going to analyze every single one of the markets that you are going to be interested in trading. This is the most common known website for you to analyze your markets. I've been using this only website, and I've never heard of any other trader really using another different website, but this is where you're going to be able to actually identify if you're interested in buying or selling a market, right? So for example, let's say we're going to go trade Euro USD, for example, right? And we're going to go to a different server just for examples purposes. So for this different server, you can tell here that Euro USD, this is what it looks like, right? So this right here on the chart, as you can tell, is the candlestick option. So we're going to take it a step back. And I know I was going to tell you guys how to use the no gap candlesticks. So right now, if I were to hypothetically actually input my actual candlesticks, 1 second, it should pop up something like this. Let me get them to pop up. We come to settings, we go to symbol, body, borders, and wicks. Okay, so as you can tell right here on Euro USD, on the weekly time frame, for example, and then on the ICE server, this has many gaps. So as you can tell, this market has a gap here, has a gap here, has a gap here, gaps throughout all here, which make the market look weird. If we were to look at it on the daily time frame, you can see more of these big gaps right here, these weird fills in the market. It just looks very weird, and it personally just throws off my trading as a whole. So what I like to do is I like to use this indicator named the no gap candlesticks indicator. So all you have to do is go to this indicator section over here. So just pause the video right now, or open up your TradingView real quick, log in, create an account. It's going to be very basic. Once you log in, create your account, you're going to get the candlesticks that are going to be popped up, and down over here, you're also going to get the volume section, which is going to be popped up Probably something like this should be somewhere over here. You're probably going to get some bars down over here, which are going to be like some big blue, no, some big green and red bars. And all you really have to do, they're going to be a bunch of bars like this. All you have to do is just click on those bars, right click on it or double click on it. And then just once you click on it, there's going to be a pop-up and then it's going to say volumes. Just unmark the volume. So you're going to double click on it. It's going to say volumes up over here. Just click on it and then it's going to remove this section down over here. All that does is really just clutter the chart, just creates extra noise. You're never going to use that option. It's very unnecessary, right? So once you have that, you're then going to have your candlesticks most likely with these gaps. So the easiest way to get these gaps removed, it's actually very easy. All you have to do is come over here, click on the indicator section and then search up no gap candles. And then you're going to get this first one. The second one works well. I personally use the first one. Once you click on it, as you can notice, immediately right away, the markets look different. There's already a difference inside of the market, but you can't just automatically click on it and expect for it to work, right? What you have to do is once you click on it, so let me just remove this one because I don't want to have two of them. Once you click on it, what you actually have to do is double click the actual market. And then this right here is going to give you the current candles. And all you have to do is click off the body, the borders, and then the wicks. And if you notice, there you're going to be left with the actual no gap candles on the ICE server. So basically somebody created an indicator that fills in the gap for those candlesticks that have gaps, right? This is just a very simple indicator. And this is not really an indicator. This is more of just an actual tool that's going to help you have the markets be as clean as mine. So once again, if I were to take a couple of steps back, this is without the no gap candlesticks indicator. As you can see, there's gaps right here. I then turn on the gap candlestick indicator and then it has a fill, but it still looks a little off. So all you have to do is just double click those candlesticks. Once you double click them, you uncheck the body. As you can tell, look at the difference it makes here in between that body and that wick. So you check off the body, check off the borders, and then you check off the wicks. And then you have a real market movement for how the market should look without the actual gaps. So this right here is a little bit of a hack. This I learned pretty late into my journey. And once I learned it, it did clear a lot of things up, right? I just wanted to get that to be the first thing that I teach you when it comes to TradingView, because I know it would probably cause a lot of curiosity. Right? We're going to get into the EMA, what setting my EMA is and how to use it in just a second. I just want to give you an overall training on how TradingView works. It can be very overwhelming at times, depends on how much you look at it. What should you look at? What should you not look at? So we're just going to break down the most important things and the things that matter and don't matter, right? So we're going to start off right over here at the top left, right? So over here at the top left, as you can tell, we have the market. So this is Euro USD. This is the market that we are currently looking at right now. If you want to change the market, all you have to do is click on that search bar right there, and then you can type in whatever other market. This is basically for you to search up any market that you can possibly imagine of. You can literally just search it up here and it will pop up, or you can just simply type it on the keyboard and then it will also pop up. It's equivalent to the same exact thing. You click the plus sign, it's going to create pretty much the same exact thing. Next to that, you're going to have the time frames, but you might only have one time frame pop up. It might be the daily, the weekly, or the 4 hour. You click this little arrow down here, and once you click this pop up, you're going to get all of these different time frames that are going to pop up. You have the 3 month, 1 month, 1 week, day, 4 hour, 1 hour, 30 minute, all of these different time frames, right? All the way up to the 1 second, which you're never going to be using. As I've mentioned before, I only use the weekly, the daily, the 4 hour, the 2 hour, the 1 hour, the 30, and the 15 minute. Now, if I were to uncheck these stars right here, what ends up happening, as you can tell, is it removes them from this top section over here. This is basically just a little bit of a hack that makes these time frames just pop up over here and stay there saved. So whenever I want to go from one time frame to another, it's a lot easier and I don't have to go into this section over here and add it or manually look for the time frame. These are all the time frames that I use. I don't use any other time frames. And whenever I'm going to be going in and out of a time frame, this is how I am going to be looking for that. The section next to that is all the different types of candlesticks that you can potentially use. As we've already broken down. All of these are just information overload. You don't need to know what any of these candlesticks are. The only ones you need to focus on is the line chart and the candlestick chart. Now, don't worry, in just a second, I'm going to be teaching you guys how to properly use the line chart, what it's used for, and all that stuff. Don't worry, one thing at a time. Once we get to there, I'm going to break it down and you're going to see how simple it will be. But this section here is just for you to identify the actual type of bars that you want to pick. This is the style. Indicators is pretty self-explanatory. You can pretty much search up any type of indicator that you can possibly imagine. Here, there's going to be endless indicators that TradingView offers you. And I think the only indicator I have ever searched up is the EMA. I've never really gone into this indicator section. I know this is a never-ending journey or world in here. Inside of the indicators, there's a bunch of different types of indicator traders, and I don't know anything about it. All I know is that inside of this indicator section is where I find my EMA and my no gap candlesticks. That's it. I've never used this area for anything else. This is for an indicator temple. Once again, this is another thing when it comes to the indicator. I have actually never even gone into here or saved anything. I'm not sure what it's used for, so I can't really educate you on something that I've never used and I've never found any use for it. Next to that, we have the alert section. So this is if I want to place an alarm on the markets. So right now we are on Euro USD, for example, and I want to be notified once price crosses through a certain point. So right now we are at 1.17331. Price right now is at 1.17331. So let's say we want to get notified once price goes to 1.7400. And it lets me know. I get a notification on my phone, I get a notification on my computer one time when it does that, or every single time it does that. So it can happen more than one time per minute, or it will only be letting me know one time and it won't be repeated. And I can put an expiration date and I can make this pretty much indefinitely, right? I can click create. As soon as you click create, you can tell how the alarm or the alert pops up right here on TradingView. So let's say for whatever reason, I want to enter this trade when the market gets here, but I have to run to the gym. I have some groceries to do. I have to step out of the house. I have to step out of the office. I don't have to be glued and stuck in front of the computer. This alarm here will let me know once and if price ever does that. If I want to move it up, all I have to really do is just drag it up and then the alarm gets dragged up. I want to move it down, just grab it and drag it up and down. I can pretty much also squeeze price in here. And another way to how you can add an alarm is over here to the right hand section. You can just click this plus sign and then you can click add alert. So that's when price gets to this area right here. If I were to click on this as well, I can add an alert when price gets to the EMA, for example. If I want to delete it, I just right click on the alarm. If I once again click this right here, I will be notified once it hits this area. It's pretty much never ending different types of ways on how you can set up the alert. The only way I ever use it is I click this button right here. I add the alert at that point, and once the market gets to the point that I need it to get to, I do whatever I've been interested in entering in the market. If I want to delete it, hover over it, click right here and click delete. It's very clean, very seamless, and very simple. I get very creative with my alarms. What I tend to do is I trap price. So I'll put an alarm up here. I'll put an alarm very tight into this area right here. And I'll know when price breaks below or breaks above. And sometimes I get even more creative and I right click on the alarm or double click on it and I'll place a message. Or I'll be like, your USD is crossing this area. Enter now, bro. Or you got stopped out. So whenever the alarm hits, all you really have to do is look at your phone and you're going to know what the alarm is going to be about, right? So this is a little bit of a message that you can leave yourself whenever you place the alarms at whatever the area is going to be. So that's pretty much all it comes when it comes to the alarm sections. These are all of the notifications and how you can set it up. You can get an email, web link, sound, just however you want to set up your alarms. This is the way I have it set up, and it's been working perfectly for me up to this point right now. We can get as creative as you want. This little arrow is basically the back. So let's say, for example, I had some drawings set up into the markets, and after these drawings, I ended up just accidentally deleting them. All I have to do is just click back and it comes right back. If I want to go to where I was, I just click forward. Pretty self-explanatory. This little bar right here, don't worry, we're going to get into that just a second. Just kind of going along the order of how everything is placed. This right here is basically the area that reflects the actual price of the market and where the market is. And these are the numbers that are reflecting it. You may see me sometimes grab this, and it basically all it does is that it moves price up, moves price down. All you have to do is just left click on it and then squeeze it, hold it up and down, and then you're going to be able to either look at the market in a much wider format or in a much tighter format. It really depends on how close or how zoomed in you're trying to get to the market. Continuing up over here to this top section, we have the square button, which is a layout setup. So this is different types of ways how you can look at the market, or if you want to split it in between two markets like this, you want to split it into never ending different styles, you can pretty much go free for all with that. I personally always just have it in the standard one market layout. This unnamed, I don't even know what this is, to be honest. Maybe this is just a settings area that you can do something about saving your charts. I always have it set up like this. I've actually never even change this right here. I have no idea what this is. But the button next to that is the quick search. I have no idea what this is either. I have never used it. This right here is just the settings on TradingView as a whole. So the settings is once again about the candlesticks. Obviously, I don't have my candlesticks checked because I have the no gap candlestick setting option on the TradingView. This is what I have for the status scales. Oh, this is the volume button right here. So as you can tell, okay, never mind. I thought that was going to pop up the volume down over here, but yeah, I guess that's not it. Is it somewhere here? It's not, but this is how I have my settings. I don't really mess with this right here. I've never really have. I don't really understand how to modify or do anything when it comes to any of this stuff. This is pretty much how I've had it for years. It pretty much stays the same every single time. And this is how I have everything set up. So I guess you can pause it, look at yours and make it look exactly like mine. This is what I do to set up my charts every single day, right? So moving along with that, we have this button right here. So this is basically to make the market pretty much full screen. So the whole entire screen, as you can tell, is just the chart right now. This is a very clean format on how you can look at the chart if you just want to focus on the actual price and not get distracted by any of the other buttons that you may have. And then you can just click the exit button on your keyboard, the ESC button, and then it returns back to where it was. But it's a pretty cool feature in order for you to just see the charts and not get distracted with all of these different buttons. Little camera button is so you take a screenshot or take a snapshot. Screenshots basically this page, saves it for you, and then you can go ahead and save that to your desktop, to your trading journal, wherever you want to save it. Moving on, next to that, we have the publish button. I've actually never published anything inside of TradingView. I guess TradingView has communities of other traders that post stuff in there. I have no idea what that is, but I've never really used it. Moving on over here, we have the blue list. So you probably have a red list, which is a standard when it creates your first account. But inside of this blue list is where I have the markets that I am currently trading. So as you can tell, all of my markets are currently tagged with a blue tag, because this is the markets that I trade. I pretty much picked this color blue when I started years ago, and I've just stayed with this blue list, and I've stayed very superstitious to this list. These are my profitable pairs. These are the pairs that I tend to find the best market opportunities in, and I don't plan to modify them for anything. Now, you guys probably can't see them because my face is in the way, but these are all of the markets that I personally trade, and I don't plan to change the color blue. I don't plan to change these markets or add any other markets. This is more than enough markets for me personally. I'm very superstitious with them, and I like them the way that they are. So I know here when it comes to the blue list, you can add stuff here. I've never even clicked on this option, so I don't even know what it is. I believe this plus sign is if I want to add a symbol. But another way that I can go about adding a symbol is by simply just searching it up. Let's say I want to add AUD NZD, for example. All I have to do is just click on this little flag button over here. And once I click on it, I can pick the color that I want to pick. And as you can tell, the default color is going to be blue. And then AUD NZD will pop up as the last option all the way down over here. Now, I actually don't like trading NZD USD. So for now, I'm just going to click on that flag and then it will automatically get removed. And then I no longer have AUD NZD there. This little pie area is advanced view. I'm actually going to be clicking this for the first time ever. Okay, well, I guess this is what it does. And I have no idea what that does. So we're not gonna, I can't break something down that I have no idea. Here on the settings option, this pops up, the volume, the change, and all these different stuff over here. Honestly, let me see, what is this? Okay, there you go. That takes away the price. This takes away the change. And then this takes away the change percentage. Honestly, I might just leave it like that. That looks a lot cleaner. And when I go like this, I guess, yeah, actually, I like that a lot better. I mean, honestly, it looks kind of cool when I had all of these, right? Because it looks like I'm onto something. But basically right there, that's just the options that this can pop up. I don't even know what this change percentage is. I don't know anything about this. All I know is that this is the price. So Bitcoin's at 115,000, XRP is at this, Ethereum is at this, and this is the price of these markets. That's pretty much it. That's all I really know when it comes to them. I don't really know anything else inside of here. This right here is going to be the watch list and the details. So if we were to click that and unclick that, it just hides them and removes them so we can have a little bit more of some space. Or you can just simply drag it left or drag it all the way to the right so you don't have to see them. I always like having it pretty much like this where I just see the first base currency. I don't really need to see the quote. I know the order of my pairs and I'm very well in connection with them. The button under that is going to be the alert. So this is every single time your alarm gets hit. This is pretty much like the history of all of the alarms that you can have. It tells you all the details about it. I mean, I've had, I don't know, I'm curious on how many alarms I've had, but I've had hundreds of different alarms that have been triggered. And yeah, this is like the history of all the alarms that I've used. Let me see when I placed my first alarm. It's pretty interesting. I placed my first alarm 2020. Is that what it is? December 20th. Is that the day? Yeah, December 4th. So I guess the first one is down here. Oh, you guys can't see it, but right here you can see December 13th, 2020. That's when I placed my first alarm. And right now it is September 13, 2025. Dude, I've been doing this shit a long time. 5 years I've been just following these alarms. I didn't find out about these alarms until like a year and a half into my journey. I was just trying to predict this shit if it was going to go up or down, honestly. So as soon as I figured the alarms is when I realized I didn't have to be in front of the markets all day. This area over here is the object tree and data window. I have no idea what this is. I guess this says all the different objects I have inside of the actual chart, but I don't use this. And then this is more of like a community section. I have never engaged with anybody in that community and I do not plan to either. Down over here, I don't know what this is. I don't know what this is. I don't know what this is. I don't know what this is or this or this. Oh, you guys can't even see it. So it's even better. All the three options that are going to be at the bottom right corner. Actually, let me see if I can move myself. Oh, I hope I didn't mess this up. Yeah, let's just leave it like that. Okay, there you go. I hope you guys are seeing that right there. So these little icons over here, this one right here, this one right here, this one right here, this one, this one, this one. I don't know what any of these icons are used for, to be completely honest. I have never used them myself. Let me actually just move myself to the middle for now. But yeah, I don't use any of these options right here. I have never used them. All I use sometimes is this right here, just to block out some of the markets that I'm not going to be trading for the week. So let's say I break down my 10 different markets for the week and I am only interested in trading these, for example. I'll just use this right here as a form to just block out all the other markets just so I don't get distracted. But this tab here as well, I don't use any of the information in here at all. This is bullshit, letting you know that this is more of a buying market than a selling market. This seasonal is bullshit. This performance is bullshit. This is all just an information overload that you don't need to use it at all. The only thing that I personally recommend to be using here is this note section. So in here, you can actually write a note to yourself. So, hey, I'm waiting for a shift to structure, or hey, I'm waiting for my entry signal. And then all you would simply do is just add that, and it's going to be a note that will be saved inside of your EURUSD section. For example, on my AUDCHF example, this is a note that I wrote to myself in 2022. So that'll be a little over 3 years ago. I wrote this note to myself. These are the confluences that I had to sell, for example. And these are just notes that I can just write to myself in here. But yeah, this in here, I don't use this at all. I don't use this right here at all. This is just a bunch of information overload that you don't need to have. Once again, I just have it here because I think it looks cool and I personally like it. You know, whenever I post videos on Instagram or here on YouTube, looks like I'm more of an expert than what I really am, but this really does absolutely nothing. Right. So now that we understand that, I'm going to move myself back to that right hand corner. There we go. So coming back over here, down to this section of the trading view. I don't know what this little option over here is. I guess this is the time zone that I'm in, whatever time zone the market was, like whatever trading view was created on, this is what it is. This is the time zone that I have. I've never really modified this. This down here is going to be the actual calendar of the chart. So you can tell this is September 3rd, 5th, 9th. So these are more of the days. And the further you go back, you can just see the months continue to go back, even the years. We have 2025. We go even further back. We have 2024, 2023, pretty much so on and so forth. So down here is the date of the markets. And once again, you've probably seen me grab this just to use the markets left and right, hold on to the screen and move it up or move it down. You can also move it to the left. You can also move it to the right. It's just a different way of you adjusting the charts. This area right here does pretty much the same thing. You right click on it, you move it to that area. You click this area, you move left. You click this right here, you move right, or you click on the reset the chart and it just resets it back to how it should originally have been. Moving on down here, you have this area over here, which is going to be the 1 day, 5 day, 1 month, 3 month, 6 month. I don't really know what this is. I'm sure if I click on it, it's probably going to take me to something like that. I don't know. I've never clicked on it. I've never clicked on this button either. I did do this one time by accident, and I brought this up. I'm like, whoa, what the hell is this? And I guess this is just a different way for you to pretty much just set up, I guess, your bar replay. And I just realized that I did skip a button, which is going to be the bar replay. So the bar replay is actually something that you use to back test. So I just clicked on that button, and let's say I want to back test. I can just start back testing, let's say from this point right here. I right click it, and then all I would have to do is just start. I click the play button, and then it's like if I were to be back testing, I can pause it. I can speed up the time of the candlesticks. I can change from a certain time frame to another. This is basically the back testing tool that TradingView has to offer. It's a very cool feature. And personally, I don't recommend back testing. I actually hate back testing. I think it's one of the biggest mistakes that traders do when it comes to back testing, because it creates a false expectation of what trading is really going to be like. I have my personal opinions on it. And, you know, once my students join the community, I explain to them that live testing is the best thing that you can possibly do, because when you go back test, you pretty much just saw what ended up happening here, right? Whether you try and forget or whether you get a friend to come pick the market and select the bar replay button, it still is not the same, because right now we're on the 4-hour time frame, and this market just had all of this move right here, and that just happened in literally 2 seconds. And in real life, this took nearly 36 hours to happen. So there's a big patience factor that back testing does not take into account. And I feel like it gives a false perception of what trading really is like. That's why I'm personally very against back testing. And I'll give you guys, you know, more details on my thoughts on that later as we go through the actual strategy part and how you should actually be trading and what you should be looking for and what you shouldn't be not. But yeah, I just realized that I overwent that bar replay button. But continuing down here, yeah, I've never really used this area down here. I think about a year ago, I accidentally moved this up, and then I realized something down here even existed. I don't know what this open panel or maximize panel even is. Moving down over here to the left-hand side, you're going to have this little star. So this little star is actually this toolkit right here. So this toolkit, if I were to click the star, it pops up. If I don't click it, it won't pop up. Once I have my toolkit pop up, these are all of the tools that I actually use to analyze the market, that I use to determine whether this is a good trade to buy or whether this is a good trade to sell. Now, these are all of the tools that I personally use. These are all of the tools that TradingView has to offer. If you were to right click on the trend line and tools, you're going to get many different formats of trend lines and many different ways that you can identify the market. You can get this type of tool. You can get this different type of trend line here, for example. You can get a trend angle. I have never used this in my life, and I have no idea what they are used for. I only use inside of this line section. I use the trend line, the horizontal line, and the horizontal ray. For you to get access to it, all you have to do is just put the star. Click the star, and you're going to notice that it's going to automatically pop up on your own custom toolkit bar. All of these other different types of trend lines, I don't know what this is. Like, the fuck is this? This is a pitchfork? Like, how? It's literally named pitchfork. Then this is a shift pitchfork. Like, what the fuck is? I don't know. This, in my opinion, is just too much information. And believe me, when I was learning how to trade, I was here breaking my head, literally trying to figure out, first of all, what is a pitchfork? Like, what is an inside pitchfork? What the fuck? Like, looking at this now after I've been trading for such a long time just makes me feel extremely happy that I actually was able to become a profitable trader with this amount of information overload that, you know, these different platforms have to offer. You know, they don't do it in a malicious way. They just do it because, you know, their business is to offer all of these different types of tools just so anybody and anybody can use it. But what nobody teaches you is that you don't need to know or learn every single thing inside of this platform for you to determine if a trade makes sense to buy or sell. You really don't. But all of these tools that I have here, the trend line, the horizontal ray, and the horizontal line are the only lines that you're going to be needing inside of this section. Moving on to the section below, you have the Fibonacci. So once again, there is a quintillion different amounts of Fibonacci tools and different formats that you can use. I don't use any type of Fibonacci. I don't use any type of can or what. I don't even know. Like, I think this is the biggest. I don't even want to say anything, but I don't know. I'm telling you, I just looked back and I really tried to figure out how to make something work with this right here. And you guys don't understand how much time I wasted by doing this. This really messed me up, guys. I mean this in the most humbling way. Like, this really made me lose a lot of time. So you won't need to be learning any of the stuff here. They can pretty much nuke this whole entire tab right here of the Fibonacci, and that will change absolutely nothing in my trading. Next, we have the pattern section. In this pattern section, you have all of these different types of patterns. The only pattern, let me see what this one looks like. What is this? The cloud? Like, how does this even make, what does this do? I don't know. Oh my God. What is this? The S line. Yo, what is this, bro? This looks like a heartbeat. This is like, bro, this was my heartbeat trying to learn this whole trading shit, trying to figure out if I should be interested in buying or selling. Like, this right here is not a trending, I don't even know what this is. Oh my God. I'm so passionate about trading that sometimes this type of stuff drives me crazy because it can just completely mess up somebody's journey. The only pattern you're going to be needing, ladies and gentlemen, is going to be the head and shoulders. So just put a little star on the head and shoulders pattern, and then it should pop up right there into your toolbox. Below that, you're going to have the projection. You're going to put a star on the long position and the short position. These are very self-explanatory. Whenever you're going to buy a trade, this is the long position you're going to pop up. So whenever you buy a trade, you expect for you to pre-calculate your risk. So in here, let's say you're only willing on losing $100. And then if you were to then have a 1 to 2 risk to reward, for example, which is what this is set up right now. So your risk to reward ratio is a 1 to 2. So you're risking $100 here to then making $200 here. So this area is where then you're going to be making $200 in this area right here. So you're risking 100 right here. And if you win 200. If you notice, it is literally the exact double size, and that's what makes it a perfect 1 to 2 risk to reward. So you're risking 1 to gain 2, or you can risk 1 to gain 3. Just simply triple that, and then there you go. So you risked 1 to gain 3. You could do gain 4, 5, 6, 7. It's all based off of this number right here. So this right here is a 1 to 5. So you're risking 1 to gain 5. Right here we have 4, and then we have 5, for example. So this risk to reward tool works for buys, and then it also works for sells. So here you're risking 1 to gain 2. And I'm going to be explaining to you how to properly place this, where it should be your minimum risk to reward tool, why it should be, and the whole entire philosophy behind that. So that's what the risk to reward tool are going to be. And I feel like I didn't really mention these other tools over here, but trend line is very simple. It's just a trend line. We don't really use it as a trend line. We use it more to create our structure points, and I'll explain all of that later once we get into that. Our horizontal line is just so we can identify a line that goes pretty much across the chart, and a horizontal ray is pretty much the same exact thing as the horizontal line. It's just from a certain point. So instead of it being the whole entire market, we could just place it based off of this point. Makes it very simple so the market and the charts don't get too cluttered up with an abundance of information. So the head and shoulders pattern is used as a reversal pattern, and this is so you can determine where the left, the head, and the right shoulders. If you guys have been following me for some time, you're probably going to notice that I repeat this pattern time and time and time again. That's because this is simply one of the most powerful patterns in the market to date, and it's the one that has led me to have the majority of my success. But there's a very specific way on how to use it, and don't worry, I'm going to be breaking down how to use this pattern accurately later into this video. For now, I'm just showing you what TradingView is and what you should be focusing on and what you should not be focusing on. This is pretty self-explanatory. You might have it full of different colors. It might be pretty ugly when you have it. All you have to do is double click it or right click the head and shoulders, go to style, and you can pretty much style it however you want. You can put it available on whichever time frame you want, change the colors, put the borders however, and you can make the background however you want. I'm sure it comes ugly. Probably does. Probably comes with a bunch of different colors and ugly like this. I just have it as simple and as clean as it can possibly be. But I'm going to be showing you how this works later inside of the video. Next, we have the long and short positions. We won't be needing anything else down from over here. This is crazy. This is basically saying that it's going to predict the next move. It's pretty cool. I'm not going to lie. It's for like a tattoo or something, but not to make money in trading. Honestly, that makes no sense. Next is the brush. The brush is just used for my educational purposes whenever I want to mark up structure points or whenever I want to mark anything off and show people or just set a reminder of something. I'll just circle it and I'll know to come back to it whenever is needed, just to pretty much note things down. The rectangle is going to be used as a box. This is where you're going to place your zones of support and resistance. And I'll be breaking down support and resistance later. So make sure you have this box. It's going to be very crucial and essential that you have it. Once again, if you don't like your colors, double click it, right click it, and you can pretty much change the colors however you want, or you can just do it based off of this other tab right here that pops up. And then here you can go based off of the custom colors that you want to go ahead and make your box. I always like making it as light as possible so you can actually see price. Some people like having it super dark, and if you have it super dark, you literally cannot see price. The box is blocking price. I like making it around a 4 to 5%, just so it's a very light tint so you can identify if you're in or out of the box, but you can also see it. Next is going to be the rotated rectangle. And this one I'm actually going to unclick. I accidentally had that one in my favorites. Next is going to be the path. This one is something that I use to identify market structure, and I follow where the price is going to move. Or when I have a prediction from the market, for example, like let's say I want the market to have a retest of this area right here to then buy. I do this whenever I analyze the markets every single Sunday with my students and I give them my top markets. I will do something like this. So throughout the week, they know exactly what they should be looking for and wait for the market to do something like that. Basically, this is just me setting up the path that the market should follow in order for me to be interested in the trade. Next to that, you have the eclipse. The eclipse is just another form of you placing a circle. If you want to go ahead and zoom into a market, for example, let's say I want to go to the lower time frame on this area right here. I just put the eclipse, I put a circle over here, and we go down to the 30-minute time frame. And on the 30-minute time frame, I know that that's where on the 4-hour time frame I had it circled, and I'm going to be looking for whatever market structure or whatever learning lesson that I need to look for right here. If I want to see how this specific market looks like on the weekly, I know that all I have to do is go to the weekly, find that circle, which will obviously be a lot smaller because you know that the higher the time frame, the tighter it's going to be. This is what that circle will look like on the weekly. If I want to see it on the daily, this is what it's going to look like on the daily. It's just an area for you to be able to identify the market, and you can tell where you are in that market, and then you can go and look at the details then. So that's going to be the final tool that you're going to add inside of this section. Next to that, you have the text and notes. You want to make sure you can add the text tool. So this right here, so you can write down your actual confluences onto the chart. So whenever I want to write down a note to myself, I can either use this option over here. So I can use this notes option in this area of the trade, or I can actually do it right on the chart, which is where I like it a lot because I'm literally placing it right on top of the market. So for example, here I am waiting for the market to come back to my area of interest or area of interest. Now, if I want to make it longer, just go like this. If I want to make the text smaller, I click this button right here, making it smaller. These are all just custom, curious creature features that you can pretty much play with it, but it's just a note thing pretty much. Under that, we have the call out. Call out is pretty self-explanatory. Let's say you're going to get on a call with me, or you're going to get a call with my team and you want to review a trade. You simply get this call out, point it to this point, and it's ask Alex this, ask team this. So for example, it's just so you have the specific spot that you want to actually write it down or review it. Or if you take a trade and you took a loss, for example, let's say, for example, this week I took a loss here on NZD USD. I'm going to use the call out option. And here's where I took a loss, but I want to come back in 1 week and see how it reacted, for example, or how it reached this area, so on and so forth. Just a different way on how you can actually write down a note onto the market. Continuing from that, you have the emojis. We're not texting anybody. We're not, putting emojis here. We're here to make money, not to put little hearts on our trading view. Ladies, if you're on here, you're going to put hearts on your charts. Sorry, not that guy. Guys, if you're going to put a heart on your charts, I think you should not be here. Totally a joke. If you want to put hearts, you can do whatever you want, but I've never done that in my life. This tool right here is going to be the measurement tool. So this tool is actually very useful when it comes to either measuring the size or the time of a market. So for example, let's say we want to know how long the market took to get from this point right here to this point right here. This market took a total of 93 bars, which on the 4-hour time frame is a total of 21 days and 12 hours. So you can just click the actual candle or anywhere in the chart and drag it left, and you can see how you continuously dragging it left. This is going to continuously move, and it's going to measure how much time or the length of that move. Now that is the time wise. Now, if you want to measure it in pips, which I'm going to get into pips right now, all you have to do is just go up and down. So let's say you want to see how big a zone is. For example, let's say you want to measure this zone. You go to the top of the zone and then you go to the bottom of the zone, and you can tell that this zone is a total of 20 pips, 20.3 pips. If you want to measure the size of this candlestick, you go from the top of the candlestick to the bottom of the candlestick, and you can tell it is a total of 52 pips. And now if you want to measure it to the upside from this zone to this zone, you can tell that that is a total of 40 pips. Now, what are these pips? What is a pip? Pip means point in percentage. Point in percentage. So this is how you measure the market and the length of it. So let's say this right now is two fighters, right? So these are two fighters. This is the pound versus the Swiss franc. And this is when Mike Tyson, or this is when the Swiss franc beats up the pound. So if this movement goes down, that means that the Swiss franc is getting stronger than the British pound. This move is happening right here, and you want to measure how strong that move was. You just measure it. You get this right here, and then you measure it from the bottom up, from the top down. It's going to be the exact same pip amount. Pip is the point in percentage. So you measure that move in pips. In fighters, if they were to be fighting, oh, he knocked him down and he stayed down for example, if you were to measure this, he stayed down for 50 seconds. But in trading, this move went down 50 points. Now, this is not correlated with time, but this is just how you measure the length of the move. In fighting, you measure the length of the knockdown based off of how long he was down for example. And I'm sure there's many different analogies that I can put to it, but it's just the first one that comes to mind. Pip is the point in percentage. It is the measurement that the market has. So let's say a market goes, let's say you want to buy this market from this point right here to this point. You're aiming for 40 points. This 40 points is what the market is going to do. Now you risk you base your trade based off of these points. So let's say you want to risk $100. So if you risk $100 per point, you just do 100 times 40, and then you can go ahead and see how much profits you're going to be making. So for example, let's say we're going to have this buy position, right? So this buy position, and I know I can get this later into the actual technical parts when we get to the market, but let's say right here, our stop loss is 20 points, right? 20 pips. If we want to risk $500, we then go to our position size calculator. We can go to onextrade.com. We can go to lqh.com. They all have these cool position size calculators where you can pretty much base your account balance. And then from there, you can actually tell your lots, the lot size and all that, which I'll get into that later into the actual video. But here, basically you would tell, okay, so this has 20 pips down, and then this has 36 pips to the upside. That's how you measure how long your stop loss is going to be and how long your take profit is going to be, pretty much. The tool actually measures it for you, but this tool also measures it for you for whatever reason you want to measure. This zoom in option, I don't really know what it is. I'm going to click on it right now for the first time. Oh, I guess it's whenever you want to, okay. So I guess whenever you want to really like zoom into a piece of market, you can just get that tool. Oh, it's a pretty cool tool. And then I guess this is whenever you want to zoom out of it pretty much, but I've never really used it. Not really interested. This magnet, I have no idea what it's used for. This, I have no idea what it's used for. This is for whenever you want to lock your drawings. I never really use this option, but I do use this option sometimes, which is where you want to hide all the drawings, because sometimes when you're looking at the market, for example, let's say like my NZD USD, Like I have a lot of notes sometimes placed on the markets. And if I want to just remove all of these different noise that I have from my notes, I just look at the market for what it is. And don't worry, all those notes that I have there, I'm going to be educating you guys on what they are throughout the video. So don't try and pause it and sneak in and zoom into it. Trust me, if you try and take the short way, you're going to confuse yourself because you're not going to be educated on that information, correct? So this tool right here is just to pretty much hide all of the options for however long you want it. This is going to be the, I don't even know what this is. This is the sync drawing options. I've never used it. And then this is the delete button if you want to go ahead and delete your drawings. And then after you've favorited every single one of these tools that I've just explained right now, all you have to do is put a star and then this toolkit pops up and down. Moving on to this top section over here is where we have the actual currency market that we're interested in trading. Once again, this is just another time frame that is telling you whether it's reflecting from here. This is the server that you are in. So you can either be in the ON, the server how I am now, or whatever server you decide to pick. This is the color of the symbol that you have, the flag that you have on it. And these are just more settings that you can have and curious features on it, which I never really use. This area up here, I have no idea what this is. I guess this is the measurement of the path or the tool whenever it goes on TradingView, but I never ever look at these numbers. I just think it looks cool whenever I move it fast, how fast it also moves alongside with it. This option right here is the exact same thing. As you can tell, it just moves whenever I move the path tool, but I don't really ever use it. This right here is if you want to demo sell or demo buy into the market, which you could do that, but I've already explained that it's best to go ahead and do that on TradingView just because it's a lot easier. I mean, you can go ahead and do that within the broker and MetaTrader because you can take it with you on your phone. It's pretty self-explanatory. And then this option right here is where you can hide your indicators that you're going to be using, which the only two indicators you need to be using is going to be the EMA and the no gap candlesticks. So everything I just educated you guys on right now is going to be TradingView, right? I get it. There's a lot of buttons, there's a lot of volume, but now that you look at it and you understand it, it really isn't that complicated. All you really need are these tools that you have up here. And that's pretty much it. You don't even need to click this button right here for the alert. You can just click it right here on the right hand side. And whenever you want to search up a market, you just simply type it on the keyboard. And whenever you type it, it should just pop right up. And then it comes over here to the side. All of this other information is literally just information overload and you don't need to know any of that stuff. So this right here is TradingView. This is where you're going to spend 90% of your time, if not 95% of your time when it comes to actually executing the analysis of the market, and you're going to determine if you're interested in buying or selling. But at no point are you actually going to buy and sell off of this market. You're never going to deposit into this platform right here. This is just where you look at the market. Then you have the broker where you deposit the funds, and then the broker creates the MT5 account where you go and execute the trade. This everything right here are just simply the trading tools and platforms that you need to have when you are trading in the markets. Believe me, I wish I had these markets when I started trading, because personally, I had so much unnecessary information on my charts that just simply cluttered my time, and it wasted me from actually focusing on things that do matter, and that's practicing a strategy, not trying to figure out what every single feature inside of TradingView was, and if there was these different hidden secret websites that were going to lead me to understand if something was ready to buy or not. So on this little zap right here, this is basically the latest update of the market. Every single market will have that little lightning, just shows you where the market is at that very moment. Obviously, this is where these markets are, and it just gives you like the latest updates on it, but I never click on that either at all. These are just cool little features that TradingView has to offer. And if I didn't show it, this little lightning right here, it's just the latest updates of the market pretty much. So once again, all you need is TradingView to analyze the markets. You need a broker to deposit your funds. I recommend LQH Markets, or I recommend onextrade.com. And then the only other platform that you're going to need from that is maybe, and if anything, Forex Factory, for you to understand if there's fundamentals that are going to be happening. Now, later into this video, I'm going to explain what fundamentals are good for and how you can actually leverage that into a profitable strategy. So we'll break all that down into the future. All right, so now that you understand how TradingView works, we're going to go back to MetaTrader 5, but I'm going to show it to you here on the actual TradingView. overview just because I can show you everything on one spot. So I know we're going back and forth, so bear with me, have some patience because I'm trying to explain to you every single feature of trading all inside of the same section so you guys can know exactly how to use it all. So this right here is probably when you were looking at MetaTrader 5 on your phone and you were probably a little bit confused whether you were ready to actually either place a market instant execution. You're probably curious on what's a buy limit, sell limit, buy stop, sell stop, and these other pending orders that are right here. So this is once you are ready to go ahead and execute the trade. So let's say you're looking at NZD JPY, for example, and you're ready to go ahead and execute that trade and you're ready to place either a buy or a sell. So if you want to place a buy or a sell based off of where the market is exactly right now, you would just go ahead, go to market execution, you would put your stop loss, and then you would put your take profit, and then you would immediately take the trade. So if you were to put your take profit, it would look something like this. And then if you would put your stop loss, it would look something like this. All you would have to do is come to the MetaTrader 4 or the MetaTrader 5 app. And then all you would have to do is just place the stop loss numbers and place the take profit numbers. So the stop loss number, for example, right here, it would be on this trade, for example. If we were to look at it on this section, you could look at it either on the right-hand section, or you could just double click on it. You go to inputs and your stop loss is 87.670. So you would go over here, you would bring up your MetaTrader 5, and then you would go ahead and implement right here in your stop loss, the numbers that you see right here. So your stop loss level is going to be 87.670, 87.670. And then you would go ahead and place your take profit. So your take profit is the green area. And then on this take profit area, you would go ahead and put 88.736. So take profit, you would put 88.736. So then this right here would be your take profit positions. Then after that, you have the deviation, which I have absolutely no idea what that is. I have never placed anything on that button right there. All I know is whenever I want to trade, whenever I want to take a trade live based off of where the market is, I go ahead, I place my stop loss, I place my take profit, and then I click buy. Now, before I click buy, I need to make sure that I can calculate my risk on the position. So if you notice here, this lot size is going to be 0.05. Now you're probably wondering, Alex, what does that mean? What is a lot size? How does that work? Well, it's actually very simple. Your lot size is what's going to determine the actual risk on the position that you're going to be taking. So if you want to risk $100 inside of this trade right here, right? So for example, let's say you have a $1,000 trading account, right? Your balance on the account is $1,000. You deposited $1,000 inside of 1x trade. So on your MetaTrader 5, it says $1,000. But out of those $1,000, you want to only risk 50 bucks, right? That is what you are okay with risking on this position right here. All right, cool. That's a great percentage based off of your account. And this trade, you're going to be risking $50 to potentially gain $100. That is a positive risk to reward ratio. Now, how do you calculate that lot size that you need to go ahead and place into your position? Because once again, this lot size that you're going to be placing right into your MetaTrader 5, that needs to go directly before you click the buy or the sell button. You can't click buy or sell into the market until you haven't pre-calculated your lot size. Now, determining your lot size is extremely easy. So you can come over here to 1xtrade.com. You can go to their lot size calculator, or you can go to LQH Markets and you can go to their position size calculator, whichever one you like best. And let's say right here, you're going to put your account balance. So let's say your account balance is $1,000 for the example that we're using right now. And you want to risk 50 bucks. So 50 bucks is 5% of your account. And let's say your stop loss in pips is going to be a total of 35 pips. For example, let's say we go back to this trade right here, and this is a 30 pip stop loss. So as you can tell, this is a 30-point stop loss. This number right here, amount 750, I have no idea what it is. This percentage, I have no idea what it is. And this stop 0.307, I have no idea what it is. All I know is that this number right here, 30.7, is the amount of pips on this actual position. So let's say this trade is actually a total of 30 pips. All right, cool. Now I know for the take profit, I'm targeting to have 61 pips. Now I don't know what this percentage is, and I don't know what this target is. All I know is that this is the pips for the take profit. This is the pips for my stop loss, and my risk to reward ratio is a 2. I don't know what this quantity is, and I know this open P&L is going to tell me how many pips I am in drawdown or how many pips I am in profit, because this fluctuates depending how price is moving. But I set the time of us taking this trade right at this point right there. This is going to be my pip count for the stop loss. All I have to do is come back to my lot size calculator. My pip size is going to be 30 pips. And then what currency pair are we going to be trading? So this currency pair that we're going to be trading is NZD-JPY, the New Zealand dollar versus the Japanese yen. So all I have to do is type here NZD-JPY. NZD, 1 second. Oh, I guess we have to look through it like this. We type it in. Doesn't pop up. We could just look for it. Boom, boom, boom. And it's probably organized in order. There's so many different currency pairs right here. NZD-JPY. And then all I have to click after that is just simply calculate risk. Now my lot size, in order for me to risk $50 with my $1,000 account and a 30 pip stop loss, is 0.17. Now this trade right here, as soon as I am going to go enter the trade, when I go place my stop loss, all I have to do is put 0.17 on this lot size. I put the number of my actual stop loss, 87.650 right here. And then I put my take profit, which is going to be 88.570 at this point right here. And then I click buy. At no matter what happens in this market, Trump could come out with the craziest tweet, another coronavirus, another anything, pandemic could happen. This can have a massive candlestick to the downside like this, or a massive candlestick to the upside like this. The most I will ever lose on this position is going to be those $50. Why? Because I have a stop loss and I have it calculated with the lot size. So I know exactly how much I am risking on this position. As soon as I am entering this market, that is exactly what I am going to be risking. I will not lose any more than what I have pre-calculated here. And I will not gain more than what I have pre-calculated here. As soon as the market comes to this area, the market will automatically take me out at my stop loss at this point right here. As soon as the market comes up to this area over here, the market will automatically take me out at this area right here. The beauty of this right here is that you know exactly how much you are risking to exactly how much you can potentially gain. There is no random outcome. There is no uncertainty what can potentially happen. You know exactly what is going to happen. So MetaTrader 5, when you are going to go execute your position, and an instant execution, you have to just make sure that you simply just click zero. You simply just place your stop loss, you place your take profit, and you calculate your risk. Then you click the buy or the sell button. Now, the only difference in between instant execution, buy limit, sell limit, buy stop, sell stop, buy stop limit, and sell stop limit is that you pretty much predict or you place the area where you want for the market to enter you right away. So a buy stop is an order placed above a current price, and you're basically going to be entered into the trade as soon as the market gets to that point. So for example, let's say I place a buy stop order, right? So let's say we want to place a buy stop. I would place the market right here. So as soon as I click the buy stop option, there's only one tab more that's going to open, and that's the area where you want to place, where you want to place the price. So this is where you want to place the price. So this price is going to be at 88,145. So you are telling MetaTrader 5 that whenever the market gets to this price, 88,145, the market is going to immediately enter you the position. So this is if you have to go to work, or you have to go to the gym, or you have to go to sleep. Whenever the market breaks through this area, it's going to automatically enter you into the position with your pre-calculated stop loss, with your pre-calculated take profit. Everything is exactly the same. The only difference is that you are literally just placing price. Whenever and if price ever gets there, it's going to enter it automatically for you. That's pretty much it. When it comes to a sell stop, it's the exact same thing, but just to the downside. Let's say you want to sell this market, but you don't want to sell this market right here. And you see yourself that you're going to be having a long day at work or a long day outside of the office. But you know, once price breaks this area, you would be interested in executing the position. Okay, cool. So you just simply place a sell stop. And as soon as price is below that current price, and that's where you're going to be immediately entered into the position as if you were to be executing the market at that point. And then you have what is called a sell limit and a buy limit. So it's an order placed above the current market price, anticipating that it's going to fall. And a buy limit is basically you're placing a limit below the current market price while the market and you're anticipating for it to rise. So let's say at this price right here, you want to go ahead and you want to place a sell limit. Now for you to place this sell limit, let's say you want price to get to this point right here. Let's say you want market to get to 88.277. Once price gets to this area right here, you're going to enter the market as a sell. So let's say you identify this to be a very strong level of resistance. Whenever the market gets there, you want to be immediately entered into a sell. Once again, you predetermine your stop loss, you predetermine your take profit. You decide yourself that you're going to be busy and you can't place the limit, and it places it for you. The buy limit is pretty much the same. It's just vice versa. So let's say you don't want to buy right here because it is way too high and you want the market to buy at this point right here. You see price is going to have a reaction from this area. We're going to double click this area. It's going to be 87.723. Okay, cool. So whenever price makes it to this area, and if it has a dip down into this area, it's going to automatically enter you into the buy position. Let's say the market continues to go down. Well, you entered the market at that position. That's why I don't like using these pending orders, because the momentum coming into these zones could be very strong. And if you were just to be watching the market live, you could probably avoid a loss, because price can come very strong into this area and within the same candlestick or within the same minute, go straight to your stop loss. And just because you entered it off of a specific zone, you simply got stopped out. But if you were probably watching the market live as it was having that deep retracement, you'd probably be like, you know what? I'm going to wait for this momentum to slow down a little bit to see if I can get a better entry. And then there you can potentially avoid a loss or even get a better entry all the way down here. Instead of using these pending order limits that basically execute the trade for you, I would much rather use my alarms. So I put an alarm at these specific areas. And once price gets there, I will then be looking at the market to see if I'm interested in executing the trade. Now, I did this while I was working at Dunkin' Donuts. I worked at Dunkin' Donuts for a couple of years and I had multiple different jobs. And at no point did I put these limit orders as the decision maker to enter the trade for me. I wanted to make sure that I am entering the trade based off of a real confluence that I am actually having. At no point did I want to enter the trade just based off of momentum. And if that doesn't make sense right now, don't worry. I'm going to be explaining all that later when we actually get into the actual strategy. But that is exactly what these limit orders are and pretty much how they work. And then the only difference in between a buy stop limits and then a sell stop limit is that you can pretty much just place the limits at these types of orders. So you can either place a sell limit or a buy limit, or you can place a limit on these orders as well. Pretty much the same thing, you're just setting different limits. But I can guarantee you, if you want to use my profitable strategy and everything I'm going to be teaching you inside of this video and every other video that I've created, at no point do I ever use any of these right here. But I do have to educate you on it because sometimes temptation might be there, just in case if you are busy and you want to just place a limit in the event that you know you're not going to be in front of the markets. I think it's just a lot. Okay, so now that you guys understand exactly how a buy stop and a sell stop works, you guys understand a buy stop was when it breaks through, sell stop when it breaks through, and how these limit orders work. Let me actually just go ahead and show you over here back on MetaTrader 5 once again, right? So here we have our $100 that we just deposited. We're going to go back over to the currency market. So let's say, for example, we want to go ahead and trade Euro USD. Right, so we click on this trade button for us to actually execute the trade. Now, once again, just taking a quick step back on this Euro USD trade, if we click on chart, the chart will pop up. If on the Euro USD trade, we click details, details will pop up. And then if you were to click on statistics, statistics will pop up. The only button that we will ever really be using is just going to be the trade button, right? So we can go ahead and click the trade button. So we want to make sure that we're going to do a instant execution on this market, so we can execute the trade right now where the market is at this point. So if I were to go ahead and take you to the Euro USD chart, so from the last time that we spoke, the market has moved a bit. So this market right now on Euro USD is, for example, let's say at this area right around over here. So if we would have actually entered the trade where I placed it last week when I was recording this video, we would have actually won this trade. This would have been a beautiful win from the market where we were actually executing the trade. But we're up over here now, right? So this trade is having some pretty clean momentum. Let's say you want to buy this market. So we're going to go ahead and go to MetaTrader 5. We're just going to put a 0.01, which is the smallest lot size that you can possibly put. And we're just going to put market execution and say we want to buy this trade at this point right here. Let's put our stop loss very tight at this point, and let's put our take profit very tight to this point right here. So our stop loss is 1.18001. But our stop loss 1.18001. And our take profit is going to be 1.18308. And we simply just click buy. And that's it. We're into the market. Now, as you can see, as soon as we entered the market, we are in some drawdown in this position. Now, this position is, once again, is in drawdown because we are obviously having a cost to enter this trade, which we are having some fee, some spread. And as you can tell, that fee and that spread, it pretty much was already gone because the trade is in momentum and we're going into profit. And once you start making profit, those fees are pretty much, you don't even see them anymore, right? So this trade right here, if you were to want to close it, you can just tap on it, and you can click close position. You can modify position, go to chart, or click on bulk operations. Right here, you can see your exact stop loss. Once again, to the bottom left corner of this pop-up tab, you can then see your take profit, the time, and the swap. The swap is the cost for you holding the position overnight or over the weekend, and the fee of that will just pop up there so you have an idea on how much actual profit you are in this position. So at this very moment, once you enter a trade, you pretty much just have to set and forget and let the trade do its thing. You either let the trade hit your stop loss or let the trade hit your take profit. Now, later on into this video, when I'm going to actually teach you a strategy and how you actually execute these trades at the right areas, you're going to know when exactly to enter and how to manage your trade. Because a lot of traders, they maybe know how to analyze the markets, but the reason why they're not profitable is because they don't know how to properly manage a trade. And I want to educate you guys on different ways of actual trading first before you actually know how to manage a trade, because you first need to learn how to trade before you can learn how to manage it. And while I was just talking and explaining that, you can just see how we went from being negative 20 cents to pretty much now being break even or positive 2 to 3 cents. Now, if I were to want to close this position, all I would have to do once again is just click on that close, click on the tab of the actual trade. I could go ahead and click close. And at this point, I would just click close. That orange bar that has just popped up there, and it would say you would close with 13 cents in a loss. Now, if you don't want to close in a loss, you can just wait. And if you want to modify your position, you can just click on modify. And let's say for whatever reason, you want to open your stop loss and make it a little bit bigger, you can just simply modify your stop loss. So let's say you want your stop loss to be 1.17966. All you have to do is click modify and you come here and modify 1.17966. And then you just click modify and then you stay in the exact same position. You just simply modify your take profit. Let's say once again, you want to modify your stop loss. Well, let's say you want to modify your take profit to this area over here. Cool, not a problem. You simply get this, and now your new take profit is 1.1413. It's always good to double, triple check because these numbers literally determine your profits. Click modify, and now your trade is modified. You don't get moved into the position. You don't get entered into a new position. You are just simply modifying your position after you have entered it. So this right here is every single button that you're really going to be using when it comes to the MetaTrader 5 once you're in the position. Once you click on trade, it could just give you the option to add another position. If you were to click chart, it's going to take you to the actual chart on MetaTrader 5 just so you can actually see where your stop loss is on the chart, which would be at this area right here, gives you a real representation of where it is. And then where your take profit is, it gives you a real representation of where it is. If you were to click bulk operations, if let's say you were to have many positions available, this would enter you in all of these positions at the same time. So let's say I agree to the terms and conditions. I click on bulk operations. I can close all positions, close all losing positions, close all buys in position. It just depends how many positions you have open. You can customize the execution that you want to do at this point. Personally, myself, whenever I actually go close a position, I usually tend to have multiple lots open simply because I have a lot of trades at the same time. I just click close all positions and it'll close them all at the exact same time. I don't have to go manually one by one and then click close. It just saves me about 10 seconds. That's really it. So that's pretty much every single feature when it comes to this MetaTrader 5. The last one and most creative one is, let's say you want to not close the whole entire position. Let's say you want to close partial. Now this would only work if we were to be in this position for more than 0.01 lots. For example, let's say we would be in this position 0.10, and you want to close half of your position, you can simply come into here and close 0.05, and then you click close, and then you would be closing 50% of your position. So this is every single feature that it comes to actually executing a trade with straight market execution. Let's say you want to enter a trade and then you actually have a buy limit, for example. So let's say we want to have a buy limit on this market, and we want the limit to be based off of this area right here. So for now, let's get rid of this risk reward tool. We want to enter the market once the market hits this price point right here. So that's going to be, the entry price is 1.18120. So price will be 1.18120. Stop loss is going to be 1.17879, and then your take profit is going to be 1.8361. All you have to do is just simply click place, and that is it. So now, as you can tell, you're not in profit or in drawdown, but you have place as a market execution. So once the market comes into this area, it will automatically enter you the position while you're anticipating for it to go up. It could come into this area and then continue going to the downside, but just depends on the type of order that you have placed, it will execute you into that market. This right here is great for people, once again, that aren't available to be in front of the markets all of the time. And if for whatever reason, after you place the limit, it's been hours and the trade hasn't been executed, all you simply have to do is click it, and you can delete the order that you have placed, or you can modify it. You can either change your stop loss, you can change your entry price, change your take profit, or you can just delete it as a whole. So if you were to delete it, you just click on the delete button. It's going to give you the confirmation. And then you go to the history tab, and on the history tab, it should pop up like an order that you had in the past. Or no, since it wasn't a position, it won't pop up. When you actually close a position like this one, let's say we close it right now at 50 cents and a loss, we can see it over here, how this was a position that we entered and how it has actually closed. So this right here is pretty much every single feature inside of MetaTrader 5. And when you go withdraw your funds from MetaTrader 5, you don't actually withdraw your funds from MetaTrader 5. You withdraw it from the broker that you are going to be trading. And then that broker will reflect that price on the actual MetaTrader 5. And now, for example, let's say that we want to go ahead and withdraw our $99, right? Because we lost the position, we're not happy about it, and we just want to get the money back. You can't withdraw MetaTrader 5. MetaTrader 5 is not the broker. You need to make sure that you go to the broker so you can go ahead and actually withdraw your funds. So remember, MetaTrader 5 is the platform where you are going to execute the position. Anything related to the money in or out of the actual platform is going to be on the broker. So the money is reflected on MetaTrader 5 for you to actually place the trades. But when you want to withdraw the money, you have to go back to the broker and request the withdrawal from the broker. Once you withdraw the funds, it's going to reflect on MetaTrader 5. And then from there, you're going to go ahead and do whatever with the funds once you have withdrawn them. But MetaTrader 5 never has your funds. They don't get access to your funds. They're just a platform that just shows the trades and shows the profit and loss pretty much. But where the funds actually are within the broker that you're going to be using, whether it be 1x Trade or it be LQH Markets. So with that being said, that is pretty much everything when it comes to market orders, and how to actually take a trade, how to place these orders, every single feature inside of MetaTrader 4 and MetaTrader 5. Now, I want to get into actual types of trading. I want to educate you guys on fundamental trading. I want to educate you guys on technical trading and how I personally do it. So within this video, you guys can go ahead and actually start to begin executing trades by the end of it. Now, if you guys aren't subscribed, make sure you guys hit that subscribe button. This is one of the many videos that I'm being created for you guys. So if you guys aren't subscribed to the channel, you're going to be missing out on a bunch of videos, including other valuable ones like this one. So hit that subscribe button. It doesn't cost you anything. And personally, I believe this is going to be one of the best videos that you're going to have in order for you to learn trading from 0 to 100. So with that being said, let's continue. So now that you understand all that, let's move on to our next subject, which is going to be fundamental analysis. Now, before I get into fundamental analysis, we already know what technical analysis is. This is when for you to determine if you want to buy or sell the market, you're going to focus your analysis on the candlesticks, on price action, which you're going to be reading the candlesticks, where you're going to be reading the candlesticks going to the upside or to the downside. And that's where you're going to make a decision whether you want to buy or sell the market. It's all going to be based off of reading the charts, reading the candlesticks, reading technical analysis, price action. It's all the same thing. For you to determine if you want to buy or sell the market based off of technical analysis, price action, or candlesticks, this is what it's going to be. Now, let's say you want to base your trade, if you want to buy or sell the market off of fundamental analysis. This is focused on when you read the underlying articles of either a company that can directly reflect the price of a currency, the underlying writing of a economy on a country, a news event, or just the economy as a whole of the country that directly reflects on the currency. So fundamental analysis trading is exactly what it is. You are reading the fundamentals in order for you to determine if you are interested in entering a buy or entering a sell. You're basically going to go out there and find different articles of a certain country and see the previous times that articles similar to this reflected the price, and then there you're going to determine if it's a good time to buy or if a good time to sell. At no point do you ever go to the actual technical charts for you to determine if you want to buy or sell the market. That's what technical trading is for. So fundamental analysis traders are a bit more on the higher time frames because they're just using the overall direction of where the economy should be going, and then they make the decision based off of that. For example, if they cut interest rates, the dollar should get stronger or weaker. Or if they start printing more money, the dollar gets stronger or weaker. And then they base their trade off of that. Now, this is a lot more long-term way of trading, but some traders have gotten very creative and they've combined both of these as a whole. So they will do their main technical analysis off of price action. And then as they're going to go into the trade, they go and check out if there is certain fundamental analysis or certain fundamentals coming out to see if it can add a certain confluence to the trade. For example, let's say we would be using Forex Factory as one of these examples. Right now it's Wednesday, September 17th. And at the time of us trading today at 2 a.m, there was going to be, tomorrow at 2 a.m, there's going to be GBP news. And let's say, for example, that I'm interested in trading the Great British Pound. I can go ahead and look into this news article, and this is going to have this is basically everything that the forecast is going to potentially be. These are the other dates that it's had a very similar news event to this day. This is what they forecasted. This is what it was previously, and this is what actually happened. If you notice, it was forecasted to be 1 point up. It was actually 2 points up from the previous one. I'm sure that had a very minimal impact in the market. If you want to go and verify that, you can just go to this date on any Great British Pound market, and then you can see if it actually had some type of effect. These CPI news sometimes work. So they sometimes do this, sometimes don't. Personally, in my opinion, from my last 4 years of really like doubling down and becoming a better trader, I'd say 80% of the time, the actual fundamentals follow the technical analysis. So whatever you properly understand with price action, right? Because this is the big thing. Like, you need to properly know how to read price action. Now, I'm not saying you need to properly have a strategy for you to have accuracy with the news. No, that's not what I'm saying. I'm saying if you know how to read price action, you can be a scalper, a day trader, swing trader. You can be whatever type of trader. But as long as you know how to read price action correctly, you can determine if something is bullish or bearish. The news, 70% of the time, will follow the trend of where the price action dictates. That is a simple fact, right? Now, I'm not saying if you have my strategy or if you trade with my strategy that the fundamentals will follow that strategy. No. I'm not saying that. I'm just saying that the fundamentals will follow the overall trend of price action. And some people wrongfully analyze the trend. So fundamentals are just simply news events that come out every single day on each currency. You have some news events like CPI. You have some news events like BOC rate, overnight rate, press conferences, FOMC, which tends to be one of the biggest ones. Then we also have unemployment. We have NFP, official bank rates. These are all different types of news events that affect the currency of that country. So, for example, let's say that I am interested in taking a trade on USD CHF, or let's say Euro USD, for example, on Wednesday. Like, okay, we do have minor news events at 3:30 in the morning on the Euro. Does it make sense to take the trade? Sure. Or you know what? I want to sit on the side because I don't know what the president is going to say and it might affect the currency very significantly. And let's say I'm interested in taking the trade on Euro USD and I don't find a trade in the morning. In the afternoon, I say, okay, you know what? I'm going to use these news events in my favor. I'm going to use it to actually get out of the trade. Personally, in my experience from trading, I tried so hard to figure this out and try to find a potential edge on reading the market. And the truth of the matter is that there is no real edge. The news are going to have their news event flashes no matter what. There's some events where they're going to have major moves to the upside, major moves to the downside. And some it's going to do what it's going to do. Whenever news events come out, the brokers mark up their spreads and their fees just because that's what goes down in those news events. A lot of money gets moved because the big banks and the big institutions, they get scared. They don't know if the federal fund rates are going to get cut in their favor or against them. And then based off of that, they're going to move the money around, which in turn affects the liquidity that the brokers get, which then they have to change and modify their spread so then they aren't negative on the business. It's just the news events are a whole mess, right? And so many different things get moved around when these news events are happening. That is so much that is out of your control that in my opinion, it just logically makes more sense to just focus on something that matters. So something that you can actually look at and you can see patterns in the past. And that's simply going to be the charts. If a news event comes out and it does this move, so be it. It's not going to be every single day or every single week that you're going to have a news event like this go in your favor or against your trade. There's going to be weeks where it's going to be like this, a pretty big wick, and then it's going to go in your favor or against your favor. It can happen once or two times a month. It is what it is. It's part of the process. There's no way that I am going to modify my trading approach simply because of a news event that actually has an impact one or two times a month. The best way that I can put the analogies based off of my experience and the way that I trade and how I'm going to teach you right now is almost like if a real estate investor were to be investing into real estate, but occasionally he cannot see certain pieces of real estate and it's just a big mystery box. Now, as a real estate investor, will you sometimes take the risk and buy this random mystery box? Sure. But sometimes these mystery boxes have good deals. Sometimes they have terrible deals. But you're not going to make your whole entire real estate investment based off of something that is blind, something that you can't see. You want to make sure that you can actually look at the patterns. You can see the same thing over and over again so you can actually make a strategy based off of your approach. Now, is there some times where what's inside of this mystery box could be a great thing? Yes. But I don't know about you, but if I were to be a real estate investor, I want to make sure that I can see my property before I buy it. I want to make sure that I can go walk inside of it and I can at least have an idea of what I'm putting my money into. Now, if I were to go ahead and actually buy this real estate property, but one of the rooms inside of them happens to be a mystery door and I don't know what's inside of that door. It could either be really good or really bad for the property. At least I have some type of context that the overall property is good. I have an idea that 70%, 80% of the investment actually makes sense. And then the other percentage just simply is an add-on. If it's good, it's okay. And if it's not, it's still okay because I know that the actual core base of the foundation of the decision towards that investment was great. That's exactly what trading with fundamentals is. If you want to go ahead and take a decision just based off of the fundamentals, it's almost like a mystery box because you never really know how these news events are going. You never know what they're going to say. And then nonetheless, how the market is going to react to it. I've had many, many times where I have had a lot of analysis on a fundamentals and I have read it. And I personally believe that the market was going to, I would have reacted a certain way to those fundamentals. But then the market reacted a completely different way. So one thing is what I personally would do with that information. Another thing is what the market would do. Or the other thing that you can do is potentially have your whole entire technical analysis, have your price action, and then just have a piece of it be a bit of a mystery. So let's say I enter the trade at 1 p.m, for example, and then the news events are going to come out at 2. Okay, that can add to my trade or it can potentially make it worse. But what I guarantee you is that if you're making a logical trade decision based off of price action and you're following the strategy and you're actually executing executing the trade with proper price action analysis, the fundamentals, the majority of the time, is going to go in your favor. And trading the fundamentals alone is simply going to be a never-ending journey of you attempting to predict what is going to happen next and how the market is going to react to very, very, very big variables that are completely out of your control, and you cannot see any patterns. And truthfully, in my opinion, I just think it's a lot easier to actually have a very clear vision of the type of investment that you're making with whatever type of trade that you're going to be taking. So fundamental trading to me is just simply a mystery box. And if you make a logical trade analysis decision, this is just simply going to be an added confluence to it. But if you want to go ahead and dive into a rabbit hole when it comes to fundamentals, please go to forexfactory.com. They've been around for tens of years, and they give you as accurate as it's going to get to the information. They give you what they potentially believe it's going to be, what it was previously, and then after the event actually happens, what it actually was. But after it happens, it's no good because the move has already happened in the market. You can't obviously go back into the past to enter your trade. Now, with that being said, you understand how the fundamentals work and that it's just really a mystery box. But you're probably asking me, okay, Alex, so how does price action work? How do I actually know if something is bullish or bearish? How can I actually read and understand the market? So I'm going to be teaching you guys right now how to read the candlesticks, how to read these patterns, how to identify if something is bullish or bearish, how to do a proper top-down analysis, what is market structure, just everything when it comes to this market that I'm going to be showing you guys right now. So this is where things are going to start getting serious, because once I actually teach you how market structure works, then I'm going to teach you the strategy on how you can actually execute the trades on this market. So if there's a moment to pay attention and to be locked in and to actually be focused and be ready to write down notes, is going to be this. If you're driving, if you're at work, if you're at a social event, if you're anywhere but in your office or wherever it is that you had and focus on learning, stop this video and come back when you're ready. It's just going to make more sense for you to rewatch the video once you've already understood it properly the first time, rather than you just hearing it in the background and then you go ahead and hear it again, and then you have to go ahead and hear it again. It's better if you pay attention the first time so everything connects right from the start and you used your time efficiently while you're learning. You don't want to just be having this in the background for no reason, right? So let's first start off with what is price action, right? So price action is literally what you're looking at right here. Price action is all of these candlesticks going up and down. Price action is these points where the market hits, it bounces from, and it bounces up and down. All of this right here is price action. Price action is when the market goes up and down. Now, price action can be reflected either in these candlestick formats or in the line chart, as you guys already know. Now, price action is what's going to tell you if this market is bullish or bearish. So price action pretty much equals the chart, which equals the history, which equals almost the heartbeat or the fight. These are all the same exact thing. Price action is everything. Literally, the whole entire market is based off of price action. Price action is the candlesticks, it's price, it's the trail, it's the history. It's just like the market. It's almost like saying like the road. For you to get to one spot to the next area, like what gets you there is the road. What connects one place to another is the road, the pavement, the concrete, the signs, the highways. All of that is just, at the end of the day, the road. This is exactly what this is. This is the road to the market. This is the market leaving its trail. Price action is just literally everything. Now, price action can be seen in two different ways. One, the line chart, or two, the candlestick chart. Now, I know we already know that. We're going to be using both of these with one another. And I'm almost going to teach you something to then go ahead and unteach it to you. Right? So price action is needed to determine if the market is bullish or bearish. The only way for you to understand, and you guys can go ahead and write this down. There's a lot of things that I'm going to say that I might not type, but you guys should definitely be writing it down. Is the only way for you to determine if price action or the market or the chart or the trend or whatever is bullish or bearish is with the candlestick and the line chart, is with price action. The only way for you to determine if the market is either in a bearish market or in a bullish market is going to be with price action. There is no other way that you can tell if the market is bullish or bearish without price action. The fundamentals will never tell you if the market is bullish or bearish. The indicators will never tell you if the market is bullish or bearish. No crossover, no Bollinger Bands, all this stuff I'm going to teach you later into the future, but no indicator, no pattern, nothing will ever teach you if something is bullish or bearish like price action. Price action is going to be the end all be all area section where it's going to tell you if something is bullish or bearish. Everything that is out there in the market that is added on top of price action, it's exactly that. It's an add-on to price action. Indicators are an add-on to price action. Tools are an add-on to price action. Any possible EMA is an add-on to price action. Any reversal pattern is an add-on to price action. Price action is the core. And I'm repeating this because I need you guys to really understand and get this. Because once you get this, you get everything. As soon as you understand the proper market structure based off of price action, it is everything, right? So now that you understand that price action is everything and price action is needed to determine if the market is bullish or bearish, the market determines if it's bullish or bearish based off of market structure. So market structure is what's going to let you know if this market is actually indeed bullish or if it's going to be bearish. Market structure is everything. Market structure is every single elbow that you see in this market, every single triangle, every single reversal point, every single pointy section, every single point where the market had a move to the opposite direction. This is going to be considered market structure. So this is almost like the red lights. This is almost like the turns in the street lights. These are the curves. These are the entry and exit points of the highways. These are all of the stop signs. These are all of the turning lanes. This is all of the mergings. This is basically every single point that connects the road with one road to another, from one destination to another. The middle point is just the road. This is just the road to get you to this point right here. Once you are at this point right here, this is, let's call it First Street. Now, this First Street, it only has a turn to the left or to the right. And this turn to the right, this is just the full road to then Second Street and then back up and down. Now, this is the road. This road is just a straight road, a straight one shot to get to this street. Once you get to this stop, then you turn to the next stop. This is just a road to then the next stop. Once you get to the next stop, then it's just a road to the next stop. So every single one of these structure points, look at it almost like a stop sign. Look at it like a turning light. Look at it like an entry point to the next entry or getting off at the next exit. These are literally just points where the road needs to stop in order for you to then be able, like, let's say you want to get from this point over here to this point over here. You can't just cross over, because there's buildings in the way, there's a lake in the middle, there's a lot of stuff going on in the middle. In order for you to get to this destination, you first need to then hit First Street. After you go to then First Street, there's a stop sign, and then you need to go back up to then Second Street. And then on Second Street South, then you need to turn back into First Street North. And then on North Street first, then you actually make it to then Third Street. So from you to go from this street to this street, you need to follow the ways of the road. There is no difference in between that example and then this market structure. This market structure, in order from it to get, let's say, to this point, you need to follow the road in order for the market to get there. Now, this is going to be crucial for you to understand how the market actually works, how to determine if it's bullish or bearish. Now, I'm not saying, for example, right now that the live price needs to, in order for it to get to down here, that it needs to break this road and stuff like this. That's not what I'm saying. I'm just saying, in order for you to understand how the market got from this point to this point, just follow the road and follow the structure points. The structure points are going to tell you how it actually made it to that point. So the structure points are these points over here. Once again, are going to be these stop signs, these turning signals, these reversal areas. These are going to be market structure points. So market structure points, we're just going to write this down, right? One thing at a time. Market structure points are the elbows in the market, the turning points in the market. These market structure points are where it's going to determine is bullish or bearish. So market structure points are the elbows in the market. These are the turning points in the market, and these market structure points are going to determine if the market is bullish or bearish. If you properly read every single one of these elbows, you're going to be able to tell if the market is bullish, right? So I'm going to do a quick quiz on you guys right now, right? And I expect for you guys to get this wrong. I don't expect for you to get this right? Just going to do this right here. Is this market right here bullish or is it bearish? So we understand bullish equals up, bearish equals down, right? So the market is heading up when it's bullish. The market is heading down when it's bearish. Go ahead, pause this video and just take a wild guess, right? Cool. So I can almost guarantee you you're wrong. And even if you're right of the direction, whether this market is up or whether this market is down, you probably don't know exactly why. Right? For example, let's say if I were to give you a very complex equation, right? Let's say I already give you this plus this, for example, and then I give you multiple choice option. Oh, for example, let's say we didn't know that, but let's say I just give you a multiple choice option and I give you choice number A, or I give you choice number B, right? You only have two options and you happen to just click on the right option and you're right. Now, that doesn't mean you're right because you know the solution or you know the way on how to solve the problem. You just happen to pick the right one because it's really is a 50-50. Like it's pretty hard to get it wrong. It really, the odds are split down the middle. So that doesn't mean that you know math. That doesn't mean that you're good at it or that you should be advancing to the next point. That's exactly what this is right here. Just because let's say you pick the right one, because, you know, obviously there's only two options, right? The odds of you getting it right or wrong is pretty fair. Let's say you do get it right, you're probably not getting it right for the right reason. And that is the big problem with traders. A lot of traders happen to just guess that the market is in the right trend, but they are actually executing it wrongfully because they don't know where it's bullish or bearish based off of. Now, let me explain what I mean by that, right? And we're going to leave this right here and we're going to come back to it and I'm going to educate you and we're going to find out if you were right or wrong. So once again, pause the video, take a screenshot and just write it down. Bullish or bearish, and then where, why, or where do you think it is? And if you don't even know where you identify this market that it's bullish from, then that even shows even more that you don't know anything just yet. But don't worry, I'm going to teach you right now. It's very easy, right? So I'm going to educate you guys right now on market structure, which is everything in the market. Right now, this market is bullish, right? This is a very clear bullish market. Now, this market is bullish because it is consisted of higher highs and higher lows, or also known as HH or HL, right? Higher high is HH, HL is a higher low. So this right here is the higher high, right? This is the highest point in the market, and this is all based off of market structure. So if I double click this line, I go to text, I'm just going to put HH. So we've identified this as the higher low. Now, this right here is now going to be the higher low. So this higher low point from this point right here is going to be what took this from point A to point B. Right here, you were at 2nd Street. You had to turn right, make it to 1st Street. Now, in order for you to make it to 3rd Street, from 2nd Street, you have to go through 1st Street and then you make it to 3rd Street, because obviously there was some trees here in the middle. There was a lake. There's a big building here. You can't just go from 2nd Street straight to 3rd Street. You need to go around the buildings and then you make it to 3rd Street. Cool, right? Pretty easy, Pretty self-explanatory. Now, this market is bullish because of this higher high and because of this higher low. As long as we remain inside of this market structure, inside of this higher low and this higher high, this market will remain bullish. This market is bullish no matter what, as long as we are inside of this higher high and this higher low. The simplest way that I can put it is this is going to be 3rd Street and this is going to be 1st Street, right? We understand that. And this middle point right here is 2nd Street, right? Very easy, very self-explanatory. As long as we are inside of 1st Street and as long as we are inside of 3rd Street, this market is inside of 1st Street and it's inside of 3rd Street, right? Pretty self-explanatory. It's almost like obvious, right? Like, duh, Alex, no shit. Like, what are you talking about? Well, you'll be surprised because some people would say that right now we are on 5th Street. It's like, well, brother, how are we on 5th Street if we haven't even broken through 1st or broken through 3rd Street? Now, this doesn't make sense. Don't worry. It's all going to start clicking in just a second, right? And I'm going to try and avoid the analogies too much back and forth so it doesn't confuse you guys, but we will double down on them later into the video because it's all going to connect perfectly, right? So we'll put this in the back burner for now, but all we know is as long as the market is in between this higher high and this higher low, we are bullish. This right here could create a potential retracement into this area right here. And this is just a retracement. Now, once we have body candlestick closed above this previous higher high, this has now officially broken above the higher high, meaning we need to modify our higher high. So the rules are very simple. Once we body close above the higher high or the higher low, the market has shifted. So once I mean for the body, don't worry, for right now, we'll come back to that. But once we have closed above the higher high or the higher low, the market has shifted. And you need to modify the higher high and the higher low. So once the market has broken above this higher high, you have now shifted in the market and you need to modify this higher high and this higher low. Cool. So where does the new higher high go? Where the higher high goes to the highest high point, which is going to be right here. And where does the higher low go? Does the higher low change? Yes, the higher low changes every single time the higher low changes. So the higher low is going to go to this point right here. Now, this is another side note. If we have a new higher high, we will always have a new higher low. So if this market, once again, it creates this retracement right here, and it creates this break above. If we have a new higher high, we will always have a new higher low. So if this market has created this new higher high, it's very obvious. We will always have a new higher low. Cool. So the higher low gets moved to this point right here. Now, I like to use to identify the new higher low as just the previous structure point. And I'm going to get to all that in just a second. But as long as this market continues to be inside of this higher high and this higher low, this market will remain bullish, right? So for example, once we broke out to this area, this over here went to then 4th Street, and this over here was at 2nd Street, right? Pretty self-explanatory. We broke above 4th Street, and now we are at 5th Street, right? So this is 5th Street. And this over here is going to then be 3rd Street, right? So we are using one street to get to the other street. So for now, let's remove this one because we're already pretty far away from over here and we don't need to be aware of that. So right now we understand that this is 5th Street. This is 3rd Street. And as long as we are in between 5th and 3rd Street, we are in between 5th and 3rd Street. This right here is just 4th Street right in the middle, or we're at 5th, or we're at 3rd, we're at 3.5, we're at 4.5, 4.25, but at no point are we ever at 6th Street or 2nd Street. As long as, once again, as long as we are inside of this higher high and inside of this higher low, we are bullish. I'm gonna write this down as well. As long as we are inside, we are bullish, right? Very easy, very, very self-explanatory. Now, once we have body candlestick closed above, what happens? Once we have closed above the higher high or the higher low, the market has shifted. You need to modify the higher high. Okay, cool. So this turns into the new higher high. This will then be 6th Street. And then where does the higher low go? It goes to this point right here, which was the last point, which is now 4th Street, right? Pretty easy, right? We're just kind of following the market, and we understand as long as we are inside of the higher high and higher low, we are bullish. If we make a new higher high, we will always have a new higher low. We modified the higher low, very easy. Now, what if I told you, you see that? There's an alarm from a market that I'm currently trading right now. And we're going to do this live here right now. We're just going to see how my market is moving. So I'm actually in this position here in a major loss right now. So this is getting super sidetracked here, and we'll go back to the market structure in just a second. But as I am educating you guys live, I am also trading live, and this trade is into major drawdown right now. Not looking good, not looking good. And this other trade is looking good, but I need to wait for this next candlestick to close in the next 30 minutes. So I will wait for that. So we'll come back to this SPX 500 now. Little distraction there, but it's okay. It's good, right? To show you guys how we're executing everything live, right? So back into this area over here, right? Let's just move this a little bit more up. We understand that as long as we are inside of these structure points, we are going to be bullish. Now, the moment that this market structure breaks below this higher low, guess what happens? Now this market is no longer bullish. This market is now going to be bearish. So we went from creating higher highs and higher lows to now lower highs and lower lows. So this market went from being bullish to now being bearish. So now that this market has broken below this higher low structure point, it means that this market is now bearish. So once we break below the higher low structure point, this market is now bearish. So this goes from actually being bullish. Once it closes below the higher low, we are now bearish. Now, bearish means we are selling, and a bearish market is equivalent to lower low and lower high, or also known as LL or LH. Now, they're both basically exactly the same. A higher high is the highest high, and a higher low is a low that is higher than the previous low. When a market goes bearish, we have a lower low. So this right here will turn into the lower low. And then the lower high is going to be the low that is the last high, which is going to be this point right here. Now, don't worry if this doesn't click right away. It's all going to click in just a second. Just give it some time for me to educate you guys into this. Believe me, what I am teaching you guys right now took me months to understand. And my goal is for you to understand in just one single video. And I'm going to do that to the best of my ability, how I have been doing this for the last 3 years on educating people. So now that we have a lower low and a lower high, this market is officially bearish. Now, the same exact principle applies right here. Once we have closed above the lower high or the lower low, the market has shifted, and you need to modify this into the lower low and the lower high. If we have a new lower low, we will always have a new lower high. As long as we are inside of the lower high, the lower low, and the lower high, we are bearish. Once we break below the lower high, the structure point is now bullish. Very easy. Everything is just changing the letters. So what does it mean? Once we have closed below, so this is going to be below instead of above. Once we have closed below the lower low, the market has shifted, and you need to modify the lower low and the lower high. If we have a new lower low, we will always have a new lower high. All right. We have a new lower low. It's very obvious. It's the new lowest low. And then where is the lower high? Well, the lower high is going to be the next lower high. And I'm going to teach you a way on how to identify this market structure point literally seamlessly. And it's going to be absolutely perfect in just 1 second. I just want you guys to be able to understand the difference in between lower highs and lower lows, higher highs and higher lows. So as long as we are inside of the lower high and the lower low, we are bearish. Once we break below, once we break above the lower high structure point, this market is now bullish. So for right now, as long as we remain inside of this lower high and lower low, we're going to be bearish. So this is now going to be a lower low. This is now going to be a lower high. This market can simply have a smaller retracement, and then we have a new lower low. And then this point right here becomes the lower high, right? The lower high is always going to get moved every single time we have a new lower low. Now, let's say for whatever reason, this market decides to now do this. Well, once we break above the lower high structure point, this market is now bullish. So this market right here goes from being bearish to being bullish. So this market is now bullish. So this now gets shifted into a higher high. And then this structure point over here gets shifted into a higher low. And this market, once again, it can have its retracement into like point like this. And now we have a new higher high. If we have a new higher high, we have a new higher low. If we have a retracement, we have a new higher high. And then we have a new higher low, right? So this is how the market works. Same exact thing applies if we now do this. If we break this structure point, guess what? We now have a new lower low. So this market now goes from being bullish to being bearish. So this goes and turns into the lower high, and then this turns into the lower low, right? As long as this market remains inside of this lower high and lower low, we are now bearish, right? We have a new lower low and we have a new lower high. Very easy, very self-explanatory. So this way you can see how the market goes from being bullish to then being bearish to being back to bullish to now being back to bearish. The market is shifting constantly from bullish to now bearish. But I want to teach you guys on a trick that I like to call the snake trick. And this snake trick is a trick to identify the last structure point, which is going to equal the higher low or lower high. Alex, what are you talking about? Dude, you're talking Chinese to me. I just met you right now. I'm already 2-3 hours into this video and I still don't understand anything. Don't worry. Trust me, this is all going to start slowly making sense, right? So we have something that is called the snake trick, which is going to help you identify the last structure point, which is equivalent to the higher low or the lower high. What does that even mean? Very easy. Let's say this market is bearish, right? And we have this retracement to this point, right? Is this right here considered a lower high? No, we can only have a lower high or a lower low once we have a new higher high or lower low. So at this point right here, this market, we have yet to create a new lower low. So we have not created a new lower low in this market. So we can only have a new lower high once we have created a new lower low. So this market right here, this is the lower high, this is the lower low. What is this point right here that is being created into the market? What is this elbow? What is this stop sign? What is this red light, this turning point? What is this right here? This is literally just curb in the road. This is literally just a market structure point. This is literally nothing. It's really it. This is just another point in the market, but it's not anything significant because it has not broken above the lower high or below the lower low. So we can only have a lower high or lower low once we have broken above the higher high and lower high or higher low once we have broken above the higher high or lower low. Don't worry, it's all going to start clicking right now. Let's say this market actually ends up indeed breaking below. All right, cool. If this market actually indeed breaks below, guess what? Now we have a new lower low. So once we break the new lower low, if we have a new lower low, we will always have a new lower high. So if this becomes the new lower low, we always have a new lower high. So how do you identify this lower high? Well, you identify this lower high with the snake trick. The snake trick is to be able to identify the last structure point, which is either the higher low if bullish or the lower high if bearish. So we're going to get the head of the snake right here. And once we get this head of the snake, we're going to start moving backwards. And this snake moving backwards is going to leave a trail, right? So we start catching the snake. I don't know if you guys know, but snakes pretty much just kind of move like this, right? Snakes don't really move like this if they're going to actually be moving somewhere. They actually just move straight. They try and move very seamless. And if they actually need to turn, then they will turn because there was something in their way or something was in the middle that they had to now go this way. So let's say a snake is trying to go from this point to this point over here. If there is a log in the middle or if there's an object in the middle, the snake will simply just go around it and then continue going. But this snake is leaving a trail that obviously he had to go around something in order to get to the destination where he was looking to go. The snake is leaving a trail of his footprint almost. It's like his trail of him leaving the leaves squashed down or whatever trails snakes leave. So a snake in this market structure right here, which is the snake trick, is you're following the trail of the market. And as soon as the snake has to turn, that is going to be the lower high. Wherever the snake or the body turns, that shows that there was something there. There was something in the way and that the market had to go ahead and then turn. So the first turn of where the snake actually turns, that becomes the previous structure point. That becomes the lower high. So this is a trick for you to identify the previous structure point if you cannot properly understand how to place the lower high or the higher low. We're going to use something that is called the snake trick. So once again, right now we are bearish. This is the lower high. This is the lower low. Let's say that this market breaks above. Let's say this becomes now bullish, right? This is now broken above the lower high. Now that we've broken above the lower high, this becomes the new higher high. So this higher high, once you have a new higher high, you mandatory need to have a new higher low. So if we have a new higher high, we will always have a new higher low. You guys should have this written down somewhere. So if we have a new higher high, where is the higher low? Well, I get my trusty snake trick. And what I do is I create the head of the snake. And on the head of the snake, I just start following the market back. And as soon as the market then turns, that right there shows me that the snake turned. There was something in the way. Now this becomes the higher low. Very easy, very, very self-explanatory, right? So this now becomes the higher low. So we can only have a higher low once we have a new higher high. So let's say, for example, this market does this retracement right here, and then we have this push to the upside. If we have a new higher high, we will always have a new higher low. Cool. The higher high is always easy to put, but where is the higher low? Is it at this point or is it at this point? I don't know. Let's bring out our trusty snake trick. And our trusty snake trick, as soon as it first turns and it creates the first point, boom, that right there is going to be the perfect higher low. And it's the exact area where the market turned. So now this is going to be the higher low, right? Pretty easy, pretty self-explanatory. Now, let's say that this market does this right here. What is this right here in the market? This right here in the market is technically nothing. This is just simply a structure point. This has not broken above or below the higher low. So this is just structure. This is just market doing its thing. This is just a stop. This is just a little curb in the road. This is really nothing. Okay. What about this? That right there is nothing. The market has not body candlestick close. And I'll get into the candlesticks in just a second, but the bodies or the price has not closed below the higher low or above the higher high, meaning this market right now at this point is still nothing because we have not broken above this line right here or above this line right here. Cool. What about that right there? Nothing. We have not body candlestick below this line. We have not body candlestick closed above this line. What about now? Okay, we have now officially broken below the higher low. So if we break below the higher low, this market will then turn bearish. So price will go to the lowest low. Now, if we have a new lower low, we will always have a new lower high. We can only have a lower high if we have a new lower low. So how do we identify that lower high or lower low? Well, we're going to use our trusty snake trick to be able to identify our previous structure point. So if this right here is the new lower low, we're going to get the head of the snake, start working our way backwards. And as soon as the market has had a turning point, boom, this turns into the lower high. The lower high is the last structure point where the market had a turning point from. So this right here is going to turn to the lower high. Now, once again, as long as we are inside of this lower high and lower low, we're going to remain bearish. And I'm going to repeat myself a lot because what is required here for you to understand this market and for you to understand this new language is just repetition, repetition, and repetition. This is going to have a major move like this. Cool. We've broken below the lower low. So this is now the new lower low. Where is the lower high? I don't know, but I do have my trusty snake trick. So I'm going to get the head of the snake. We start working our way backwards, and turn. Now this right here becomes the lower high. Understanding that that is now the lower high, the market could remain inside of this lower high and this lower low, and we're going to remain bearish. This market can literally do all the structure point that it wants. As long as we are inside of this lower high and lower low, we are bearish, right? Pretty simple, pretty self-explanatory. Now let's say this market does this. Oh shit, now what? No problem, no big deal. The market has now broken above the lower high. So guess what? We are now bullish. This becomes the higher high. And where is the higher low? Because if we have a new higher high, we will always have a new higher low. Okay, so if we have a new higher high, where is the higher low? I don't know. Let's bring out our trusty snake trick. It's the head of the snake. We start just working our way back, and turning point. This right here is the higher low. So our snake trick helps us identify where that higher low and where that lower high is going to be placed into the market. So we have a clear understanding of where the market is at this point right now. Now we use the line chart that we're using right now to be able to very clearly identify this structure point. So right here, we are using the line chart to tell if something is bullish or bearish. So we know that this is the higher low and that this is the higher high. As long as we remain inside of this right here, we are bullish. If we break above, once again, this becomes the higher high. This becomes the higher low. If from this point right here, we break below, this becomes the lower low, and then this becomes the lower high, right? Pretty self-explanatory, just repeating the same thing in many different types of examples, right? Cool. Now, let's come back to this example right here, right? Is this market bullish or is this market bearish, right? Let's find out if you are right about this trade and if you were right, if you're right about the correct points, right? Because if you have, and I'm going to write this down as another note, if you identify, once you identify the market being bullish or bearish, you need to place the higher low, higher high, lower low. My computer gets a little bit slow. You need to place the higher high, higher low, lower low, and lower high. Once you identify the market being bullish or bearish, you could only identify that by being bullish or bearish by placing the higher high point and the higher low point. If not, the market cannot be bullish or bearish. So for example's purposes, let's begin from over here, right? This market at this point, when we are identifying this market, let's make this all the way to the left. This is the higher high. And then this over here is the higher low, right? Do you guys agree this is the higher high in this market and that this is the higher low, right? Very easy, very self-explanatory. As long as we are inside of this higher high and higher low, we are bullish, right? So we start moving a little bit more to the right and boom, we now body candlestick close below, or we just candlestick close below. This turns into the lower low. Now, if we have a new lower low, we must have a new lower high. So where's the lower high? I don't know. Let's bring out the trusty snake trick. This is the head of the snake. We start working our way backwards. Boom, we turn it. That right there is our lower high. Pretty easy, pretty self-explanatory. Cool. We keep working our way down. This structure point right here, does that make us bullish or bearish? This point right here, 1 second. At the time of us looking at this market like this, is that still bullish or bearish? Bearish. Technically, this market is still bearish. This is still the lower high. This is still the lower low. We are yet to break above or below this line, making this market still bearish. Cool. All right. What about now? We have officially body candlestick closed below this lower high. This lower low. So this becomes the new lower low. Where is the new lower high? I don't know. Bring out our trusty snake trick, start working our way backwards. This is the first turning point. Boom. That right there is going to be the actual lower high. Beautiful. We now modify our lower high to that structure point right there. As long as we remain in between this lower high and lower low, we're going to be bearish. Cool. This structure point right there, is that a new higher high? Is that a new higher low? No, that is absolutely nothing. We have not, this is just another structure point. This is not broken above or below the lower high and lower low. It's nothing. What about this? Is this a new higher high? Is this a new higher low? No. We have not body candlestick closed above or below the lower high and lower low. This market is still bearish, right? So let's keep this going like this. What about that? We got very close. That means we have to be bullish, right? Like we have to be bullish because it got that close to the actual lower high. Like it's got to be bullish. No, if we have not body candlestick closed above, if we have not structure closed above or below, we are still bearish. What about now? That's like 3 touches. It has to be, it's almost there. Like, come on, like just count it. Fuck it. No, if we have not body closed above or below, we are not shifting structure. Very simple. What about here? Exact same thing. We have absolutely nothing. This market structure is currently still below this right here. So we are still bearish. We keep it going. And guess what? If you called this market bullish, you were wrong. And if you called this market bearish, you were probably also wrong because you did not know from where this market structure was bearish. And this is the problem with 99% of traders. They cannot identify if something is properly bullish or bearish depending on the market structure. They just simply don't know how to read market structure. That is a simple fact. They are uneducated or they just don't care to get educated and they don't know how to read market structure. It is very simple. You can see a market that is trending like this, right? For example, and then you would probably think that this market is bullish, right? Let's say right now, take a pause. Bullish or bearish? Go ahead. Okay, it's bullish. Where's the higher high and where's the higher low? A rookie trader or somebody that thinks that they know how to trade, like, yeah, that's the highest high. And then, yeah, this is the higher low over here. Buddy, you realize how many times this market has, like, do you see how many other structure points? It's like saying, it's like if you're calling this right here 6th Street and you're calling this right here 5th Street. Are you seeing how many times in between here we have gone through so many different streets in order to get to this right here? This is not even 6th Street. This is like 10th Street. People are just confusing it because they don't know how to read market structure correctly. People are just confusing the roads because they don't know how to read the signs. They don't know their streets. That's why people use GPSs everywhere they go because they don't know the roads. This right here, people don't know how to read market structure, but there's no GPSs to read market structure. So they get these bullshit indicators for them to actually read market structure, thinking that that's the hack or the way to do it. This market right here, what if I told you is actually bearish, and it's bearish based off of something extremely obvious, right? So we'll just do it one more time, right? We have this right here be, for example, this is the higher high. This is the higher low. As long as we remain inside of these 2 structure points, we are bullish. Boom. We have body candlestick closed above. This turns into the higher high. We get our trusty snake trick, start working our way back. This is the turning point. This is the higher low. Let's continue going in this markets. We are still bullish because this market is yet to break above or below the structure point. So this right here is absolutely nothing. We are still very much bullish. Okay, we continue to go. What about this point right here? Same exact thing. This is still between the higher high and between the higher low. So we are still bullish. What about now? Still bullish. This is still the higher high. This is still the higher low. We have not body candlestick closed above or below. What about now? We body candlestick closed above. Cool. That becomes now the higher high. Where is the higher low? I don't know. All I know is if I bring out my trusty snake trick, I start working my way backwards. The first turning point, that is now going to be the higher low. That right there is going to now be moved to my higher low. So this will be my higher low at this point right here. We keep moving to the right and then we have, boom, a little bit of a break above. This is officially broken above the higher high. That's the new higher high. Where's the higher low? I don't know. This is the head of the snake. We then turn. Then this is officially going to be the higher low structure point in this market. We turn this into the higher low. And if we continue going to this market, we body candlestick or structure point close below. That small break right there counts. Yes, indeed. This turns into the lower low. Where is the lower high? I don't know. I get the head of the snake. I then start working my way backwards. First turn, that is going to be the lower high point at this point right here. So now this market is bearish because that is the lower high and that is the lower low. This right here has not body candlestick closed above this point. So now we are still technically bearish. That right there is what 99% of traders cannot do correctly. And I wish I could just educate people on just that. I don't want to teach everybody my strategy. I don't want everybody to have my strategy. I really don't. I could give a shit. I just want people to learn how to read the market. I feel as if people were just to be able to understand if the market is bullish or bearish in the first hand, then they would be able to actually be able to make a logical trade decision. Because right here, let's say you don't know how to identify if this market is bullish or bearish. You would see this market heading up. You're like, yep, buy. You're actually buying at the worst point because this market has just shifted bearish. This is having the retracement to then literally create the perfect lower low leg to the downside. This has hit the top of a trend. You've had a reversal pattern right here. This is the left head, right shoulder of this market is creating the perfect reversal pattern, retesting the neckline, and then we're selling. But you can't even tell the difference in between if it's bullish or bearish. And that's why you're losing. You're not losing because you don't have a strategy. You're just losing because you don't know how to read the market. Not knowing how to read the market, not having a strategy is already bad. But not knowing how to read the market and not having a strategy is just a combination for the worst possible outcome ever. And that's what I want to educate people on first. It's like learn how to read the market and then you can think about how you can actually execute a strategy. Learn on how to read the streets. Learn how to read the stop sign, the red lights, the green lights, the turning signals, the highways. Then you can think about speeding and getting to places fast. But you can't speed and drift and haul ass to places if you don't know where you're going and you don't know the roads. You cannot you can't buy or sell a market if you don't know the difference between if it's going up or if it's going down. This right here is going to be the core foundation of everything else that I want to teach you. So I really want to break this down to the T and get you guys to understand everything to perfection. Because once you understand this, you get everything else, right? So what I've just taught you right now is how to identify if something is bullish or if something is bearish based off of the line chart, right? Now, let's say right now I'm going to grab this market right here, right? So for example, we're going to go to the most recent price, right? This is SPX 500 right now in the live market, right? So we're going to switch from the candlestick chart to then the line chart. Now, if you were to go ahead and tell me if this market right here is bullish or is this market bearish? It would almost be extremely obvious, right? Because based off of everything that I have pretty much just showed you, you would be able to identify that this market is obviously bullish, right? You can tell that this market right here, this is going to be the highest high and that the higher low is going to be at this point right here. Right? You can tell that this market is bullish. You can tell that this market, if we were looking at it from over here, for example, you can tell that this was the higher high. This was the higher low. We body candlestick closed above this line right here. This becomes the higher high. Whereas the higher low, you get the head of the snake. And then this head of the snake, you start working it backwards. And then at the turning point, that is going to be the higher low. All right, very easy. I've taught you all this up to this point right now. You know that this is going to be the higher low from this point right here. Cool. You know, if we body candlestick close below it, we'll go bearish. So this then becomes the lower low. And then this right here becomes then the lower high. You know, if we body candlestick above this, we then go bullish. Oh, that right there did not body candle. Well, we'd have to go check if the bodies did. And I'll explain all that in just a second. But based off of the market structure, guess what? We did not break above that point, so we still remained bearish. We continue to go, and then now we have officially broken above this structure point over here. So this became the higher high, and then where was the higher low? I don't know. I get my trusty snake trick, start working my way down, and boom, this is a significant point where the market actually reversed. So then this right here is actually going to become the higher low. We break above, and then we have higher high and higher low. Very clean, very obvious, very straight to the point. This right here is a very, very, very obvious market determining whether it's bullish or if this market is bearish. Wow, I have just hit stop loss on my trade. I just, I'm looking at it here right now live. Great. I just hit stop loss. Let me make sure. 1 second. Yep, I just hit stop loss. I lost right now $153,000. Could have definitely been worse. Could have definitely been worse. I just took a trade that simply made absolutely no sense. And this trade right here that I was saying I was going to wait for the candlestick to close, guess what happened? That's what happened. So you guys are seeing this happen in real time. The market moves very fast, and you know, I'm focused on educating you guys right now. It is what it is. I missed out on this trade, but just perfect example of the market moving to perfection right here. So this right here had my stop loss. I took this trade against the trend, and I'll explain all this to you guys later. This trade, I would have taken this loss, and this trade, I missed out on this win. It is what it is. It is parts of the game. But for example, if we were to go ahead and go to a different market, for example, let's say we were, and by the way, just to show you guys, I am not lying. So GBP, USD CHF, this market right here, let me go back over here. I literally just took this loss right now. Took this loss right now for $153,000. You guys can see it right there for yourselves. $153,000. Now, I should have not taken this trade in the first place. It was a very high risk trade. But, you know, I personally accepted it, and I even recorded me taking that trade live, and I'll put the channel, my other channel, probably somewhere in the link below, where I break these trades down live and why I'm interested in taking it, so on and so forth. But yeah, this just happens to be a very degenerate trade, right? So for example, let's say we're looking at this market right here, and we're looking at it based off of the line chart, the exact same trade that I have taken. What can you tell based off of this market right here? Well, you can obviously tell that this market is bearish, right? This market at one point, this was the lower high over here. This market was, this was the lower low. We broke below. So this makes this the new lower low. And then if we were to do our trusty snake trick, this would be the head of our snake. And if we start working our way backwards, this would be the first turning point right here. This would be the lower high. So this market would have gone from bearish to then bearish, right? This would be the new lower low. This would then be the new lower high at this structure point, right? So we can tell that this would be bearish on this time frame. If we go down to the 4 hour, on the 4 hour, we can tell pretty much the same thing, that this is the lower low. And if we start doing the little trusty move, for me personally, if I were to be a snake, this right here is just another little bump on the road. This is just a little bump in the road. But this right here is a very significant turn. There was probably something very sharp, very important there. So I would put the lower high at that structure point right there. You always want to place your lower high and your lower low at the points where there's a significant move, just like this one. Something that is very obvious that the market had a reaction from like this, from this to this, to this, to this, to this. These smaller points right here aren't really as significant as structure points for me. Neither are these very small ones. It needs to be a very sharp, clean turning point. That is what's going to be considered a valid structure point. Now, for now, we're going to be using the line chart to identify these very sharp structure points, but we are going to be moving to the candlesticks soon. Now, moving on to the next subject, which is the actual candlestick trading. It is actually very easy, right? Because a lot of traders, sometimes they get confused, and what they end up doing is that they pretty much come here into the market and they'll be confused if this is a higher low, if this is a higher high, if this is a higher low, if this is a higher high. And what if I told you that it's just extremely easy for you to be able to identify if something is bullish or bearish? Just go to the line chart, back into exactly what I was just educating you guys on, and just do the exact same thing that I was showing you right now to this point. Let's say we start breaking it down from this point right here, for example, right? We're going to use the bar replay and we're going to go back. This market right here, why would you get lost in identifying if all this over here is bullish or bearish when you can really just work from this structure point right here? You can tell that this structure point right here is obviously the highest high in this market. So we're going to count this as what it is, the highest high. Now, if we were to get the head of our snake trick and we start working our way down, boom, this market has indeed reversed from this point right now. This is the first turn. So then this will turn into the higher high. and then this will turn into the higher low. Now, this market turning into the higher low confirms that as long as we are inside of this higher high and higher low, this market will remain bullish. Pretty easy, pretty self-explanatory. All we have to do now is go back to the candlestick chart. And would you look at that? We have our higher low placed perfectly at our higher low and placed perfectly at this higher high. All we really have to do here is just adjust it slightly and put it to the bodies of the candlesticks. When it comes to identifying market structure on the actual candlestick chart, it really is no different than the line chart. You just want to make sure that you are doing it based off of the bodies of the candlesticks. Do not take the wicks into account. Remember, the wicks are the trail of where the market has been, but it's not the actual structure of where the market has been. You want to make sure you are going based off of structure. So